Chancellor rips up Liz Truss's controversial economic plan as the PM apologises for the chaos. The FT reports the BOE could delay QT even further. Feeling upbeat, stocks extend a rebound after solid bank earnings from the US and negative pressure on UK markets easing. Plus, sale on the cards. Credit Suisse considers selling its US asset management business. Abu Dhabi and Saudi Arabia are exploring investing in the embattled lenders' investment bank.
Tom, when you look at futures, actually, they seem to be supported, and looking through the fact that China has delayed its third quarter GDP reading, the support, I think, also probably comes from a bit of stability in the UK, which was something that was a long time coming.
Yeah, those two catalysts in particular, as you say, the earnings picture, we heard from Bank of America, they said they had to squint to see any signs of pressure on the consumer, and of course, a sense of relief, at least temporarily, around what's happening in the UK. And the Bank of England, according to the reports from the FT, answering that question, how could you be buying bonds when you're preparing to sell them back onto the markets with QT? They have, according to the BOE, pushed back those plans around concerns about the vulnerabilities within the gilt markets. The FTSE 100 currently up 0.8% over in France. The CAC aren't gaining 57 points on a day that's been described as our Caroline Connard, our correspondent on the ground in Paris, has said possibly could be shaping up to be a Black Tuesday in terms of strike chaos in France, the pressure on the President Macron there. Over in Spain, the Spanish IBEX currently gaining 47 points, up 0.6%. We'll take in with gilts shortly, but before we do that, let's go to the cross-asset board then. And the future stateside pointing to very solid gains of 1.5%. The context is the S&P closed up about 2.6% yesterday. So it broke through this important 200-week moving average on Friday, and then it came back above that on Monday. And you have even the likes of Mike Wilson, the bear over at Morgan Stanley, saying you could see a technical rally on the back of this. He's looking at possibly 13% upside, at least in the short term. The dollar index softer for a second straight day. That is supportive as well to this risk-on sentiment that we're seeing, currently down 0.2%. The pound is at 113 after gaining on the back of that report around the BOE, pushing back its QT timeframe from the Financial Times. It's now flat, and the 10-year stateside below that 4% level at 3.99, just a move of 1 basis points. Let's check in then on the gilt markets then on the back of new news and additional information for investors to digest after, of course, the new Chancellor came in and ripped up the remnants of Trussonomics yesterday in the Houses of Parliament. So not a great deal of movement, so a little bit of calm across these gilt markets. Again, the Bank of England pushing back, according to the Financial Times, that planned QT. It already done that from October the 6th to the end of the month. Now it pushes it further out. We don't have the exact time frame yet. 3.53 on the 2-year. The importance of the 30-year back in focus at 4.33. Still well above the levels pre-mini budget, but of course significantly down from the height of the angst around the gilt market. That is the 30-year, currently at 4.34. Francine.
Tom, if we dig a little deeper into the sectors, so out of the 19 groups that make up the stock 600, about 4 on the downside, but they're really barely down. They're between 0.1% and 0.2% lower. That's healthcare, basic resources, and energy. Technology and construction and media actually getting some 1.3%, and you can see it's really just a couple of pressure on healthcare. I would point, we have a great story actually on the billionaires that won during COVID. Moderna is one of them. So it's interesting to see how some of their fortunes have turned quite significantly. Now let's get over to our Bloomberg MLive managing editor. He is Mark Cudmore. Mark, we've missed you in the morning. You're looking at UK real yields.
Yes, good morning, Fran. I've missed so much excitement over the last couple of weeks. Jeremy Hunt has restored credibility to the country, saved the gilt market, saved the pound. Yes, maybe in the short term, but longer term, the fundamental story remains the same. And this is that the UK has a very large current account deficit and deeply negative real yields in a world of rising rates. And that means that unless yields go much higher and offer more attractive kind of rates for foreign investors, the currency will have to weaken further. I think that might be a story for 2023. Let's have a little dive in. So this is a chart of where UK real yields are when you take the policy rate minus headline inflation. That's kind of the spot real base rate. It's a little bit kind of selective one way to look at it, but it's saying minus 8.2%, completely unprecedented. Going back over the last 30 years, it's completely bizarre. Now, over the last 30 years, even if you include this crazy period, the average is about 1% positive. If you go the pre-GFC era, it was normally about 3% positive, which is where I think we kind of got to get back to. So what? I'm saying we got to get back to 3% real yields from minus 8%. Does that mean 11% rate hikes? No, of course not, because this can happen both through inflation coming down, because remember, this is the base rate minus inflation, or through rates going higher, or a combination of both. So for that, we need to look a little bit forward-looking. So I'm going to go to the second chart here, which is kind of looking at one way to do this in a forward-looking way. And this chart here is 2-year yields minus the 2023 full-year inflation forecast. So that's a good way of kind of looking what the dynamic will be next year. And you can see that's only minus 2.6%. Full-year inflation forecast for 2023 for the UK are 6.2% at the moment. So that doesn't look as bad if we think it's got to get to about 1% at least. But it's still probably suggesting that we've got to do another maybe 350 basis points higher in rates, or inflation's got to come lower. Now, I think that the recent moves by the UK government, the recent U-turns, suggest more austerity, suggest a more negative growth path. So therefore, that means we might get inflation come lower, and we'll also get yields higher. So I think that's probably the story we're going to trade over the next year. But until we get that picture better, the pound will be longer term under pressure. Yes, we might trade the relief story into end of year, but 2023, the pound will get weaker again unless we see this metric correct much higher.
Fantastic stuff, as ever. Mark Cudmore, our managing editor of MLive. Mark, I should point out, a love heart has popped up in the IB chat. You don't see that very often. A lot of love for Mark Cudmore breaking down the real yield. I've never received a love heart in the IB chat. They send them to me for you. They're sending to you. Well, Mark Cudmore has one for breaking down the real yield story so beautifully for us, Mark, and welcome back. On your point of the pound, it's given up the gains that we saw early in the session, currently at 113 flat. Gilts are bid modestly, just very modestly. Again, the 30-year at 437. Let's stay with the UK story then. And the Prime Minister Liz Truss apologising for the chaos caused by her mini budget, but said she plans to lead the Tories into the next election.
My message is we should be focusing on delivering for the British public. We are in difficult economic times. We're in difficult international times with the war being perpetrated in Ukraine. And now is the time to focus on delivering, making sure that we are delivering on our energy package. So before we stepped in, people were facing energy bills of up to £6,000. We've now put in place the energy price guarantee. We've reversed the national insurance increase. And that's what I'm thinking about as Prime Minister.
Now for more, we're joined by Bloomberg's Lizzie Burden. Lizzie, it seems that Truss is really hanging by a thread. We were looking at the papers this morning, and she pretty much got slammed across the board.
Yeah, you saw her in that interview with the BBC desperately trying to reassure the public that she's in control. She meets her cabinet this morning to try and persuade them that she indeed is still the one in power. But as you say, the reality is, the consensus in Westminster is she's only clinging on. Only months ago we were talking about Johnson's government as a zombie government in its last weeks in power, and the feeling is much the same. Tory MPs, I ask, say it's when, not if, she's going to go. Ministers and aides even agree, but press them and they can't decide who would replace her. Yesterday in the Commons, it almost seemed like a bit of an audition between her cabinet as to who would take the top job. And then they can't agree how they would replace her without a general election. And that's something no Tory wants. Labour now has a 25-year record poll lead over the Tories. So they seem to be waiting for the herd to turn against her. But publicly, at least, the herd is only 5 MPs right now.
Okay, we continue to watch that story, of course. Damning headlines. Wow, the ghost Prime Minister, the Daily Mail in office but not in power. Bloomberg's Lizzie Burton, thank you very much indeed. Let's bring in Bloomberg's Christina Kino and Ben Gutteridge, Asset Management Director of Model Portfolio Services at Invesco EMEA. Christine, we'll start with you on what we're seeing in terms of these gilt markets on the back of this FT reporting then. Gilt's now selling off just a little bit, so yields up about 2 basis points on the 2-year, close to 2 basis points on the 30-year. So choppiness in these gilt markets in the first few minutes of trade. What do you make of this reporting around the BOE? It was inevitable, wasn't it, that they were going to have to push back QT again?
That's exactly right, Tom. I think it was widely expected that QT would definitely be out of the picture, at least for now, especially with the chaos that we saw in the gilt market over the last few weeks. And so a little bit of confirmation on this from the BOE sources that we saw this morning really just speaks to the urgency of the state of the gilt market at the moment and why the BOE felt the need to delay this process. And I think, you know, as far as the sell-off goes, our colleague Mark Cudmore is absolutely correct. I think now that some of those pressures that we saw over the last few weeks seem to be easing a little bit. I think the focus is returning back to the UK fundamental story, which is still not very great at this point in time. We're looking at near double-digit inflation, a cost of living crisis, and a BOE that still has to kind of pivot back to its inflation fight. It had been distracted from that the last few weeks, but that still very much remains an issue for the bank.
Ben, if you look at some of the volatility that we've seen, I mean, how long does this rally last? As Christine was saying, the fundamentals in the UK aren't great.
Yeah, I mean, it's difficult to pinpoint how long the rally will last exactly, but, you know, I think markets will fret about the political shenanigans, and of course we know the story's not yet over at Downing Street, or we certainly suspect it's not, but, you know, the collection of policies that so riled markets just a few short weeks ago, you know, it's pretty clear that we're not going back to that, and there has been sort of a commitment to a reversal on it, and I think the Bank of England has shown its credentials here in terms of fighting inflation and its willingness to sort of stand against, you know, that collection of policies, the unfunded tax cuts that would sort of seem to be so inflationary. So I think, you know, of course, as I said, the political noise can throw gilt yields, can throw the pound around a little bit in the short term, but I think we're not going back to that collection of policies, so there is room for a bit of a run here, for a positive run for the pound.
But in terms of the risk premium that is now priced into UK assets, when do we get that back down? What do you need to see that coming back down to kind of pre-mini budget levels?
Well, time certainly, right. But also affirmation that, you know, the Bank of England is going to manage technical, because things can break. You know, when you have these sort of gilt yield spikes or any bond yield spikes, things can break, and we've seen a bit of a disturbance, or slightly larger than a bit of a disturbance in the pensions market, and so the Bank of England's got to manage that, but also take on these inflationary threats. And it's, you know, it's a bit of a juggling act at the moment. I think it's managing it okay, but combination of that uncertainty about what else could sort of fall over post this sort of move higher in interest rates, plus the political noise, you know, it could be a bit of an uneasy ride. But I think that risk premium will fade based on sort of things I mentioned.
But Ben, we heard from business groups, right, welcoming the chance or the attempt to calm markets, but at the same time, they call this economically rudderless with no long-term plan and tax burden stuck at the highest in 70 years. Then you have trade unions, you know, saying, well, guys, go on strike because of the high inflation costs and you know, the return of austerity.
Yeah, this is bad news.
So it's not, again, it's just not right. This is not only about political kind of meandering. Yeah,
well, I mean, there is clearly an economic squeeze here. The inflationary challenge, even though the Bank of England is tackling it, will take a long time to come under control, and a lot of it is not within the Bank of England's gift, of course, you know, be it commodity prices, the geopolitical challenges, what happens in terms of US demand. But perhaps it's not too far away before the inflation delta starts moving in a more favourable direction.
All right, Ben, thank you so much. Christina Kino from our markets team, Ben Gutteridge, Asset Management Director of Model Portfolio Services at Invesco EMEA, stays with us. Now, coming up, we'll have a full roundup of the markets and why Mohamed El-Erian says it's getting harder to justify the Fed's independence. We'll discuss that next. This is Bloomberg.
has changed everything. People are changing the way they work and the way they travel. Can you explain what you mean?
I think the world is never going back to the way it was fully before the pandemic. And one of the changes, I think, David, has been a change in how we work. Many people had a job at an office. They're not going to be required to come back to the office 5 days a week. And I don't think CEOs per se are going to determine these policies. I think workers will, because all of us CEOs, I think, want the best talent. And I think flexibility is going to be the second most important benefit after compensation. All of this, David, has culminated in Airbnb not just being a company about traveling, but now a company about living. So there's this whole new category of travel that's not classic 2-3 nights in a city. It's not long-term housing, and it's completely emerged because of the pandemic.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Welcome back to the Open. 15 minutes into the European trading day. You're seeing gains of 0.5% across the European benchmark after a very solid session for Wall Street yesterday. And the futures stateside point to further gains of 1.4% on the S&P E-minis. Quickly checking in on your gilts on the back of the reporting from the BOE, from the Financial Times, that the BOE will push out its plans to start QT. Not a lot of movement in the gilt space. It's currently range bound, the 30-year at 4.38. Let's get back to the Fed, though. Mohamed El-Erian says it's just getting harder to justify the Fed's independence. Controversial comments. The Allianz chief economic advisor and Bloomberg opinion columnist made the comments in a tweet. He said an independent central bank is critical for the US economy, but it's getting harder to justify after 4 big operational errors. Joining us now is, or stay with us, is Ben Gutteridge from Invesco Asset Management. Ben, Fed independence, Mohamed El-Erian, of course, was out early and out front in criticizing the Fed for not going earlier on rate hikes and addressing the inflation challenges. Is this a real challenge to Fed independence? Is the damage done to this institution that deep?
Well, I wouldn't sort of question Mohamed's opinion sort of relative to my own, but I think the Fed's independence is secure, and I think there is a lot of concern and a voice about the potential delay or the speed with which they pivoted to becoming more hawkishness. But at that time, there was a lot of economic uncertainty. In hindsight, it was still a very uncertain period. And I think if we look at long-term inflation expectations, they still remain in target. So, always question marks around the choices that central banks make, but no, I don't think it's the time to be calling for an end to their independence.
I don't think he's quite doing that.
Yes, sorry.
Basically, it's getting harder to justify because of 4 big operational errors, he says, which is analysis, forecast, actions, and communication, and frankly, the lack of accountability. I mean, why were central banks so off the mark, and what does it mean for, you have to be in the markets, you're invested in equities, like, should you hold them accountable?
Well, I think one of the reasons that people have or the credibility issues has been raised is their inflation forecasting has been offside, as has so many people's. And here I am about to give you my inflation forecast that could well fall foul of the same challenge. But yeah, I think, obviously the latest CPI print was a bit hot. The labour market remains strong. But there could just be cracks appearing in the labour market. These lead indicators on inflation do point to a bit of a reversal coming as we move into year end. So maybe this November hike marks the end of 3/4
and
points.
that is the key call from Ben. Is November potentially marking
Ben's key call?
And if that is your call, then is now the time to start positioning for that within equities? And if so, where?
Yeah, well, I think, well, broadly, equity should do okay if this does mark that pivot. I think, you know, it does seem to be relatively priced in. That 3/4 is the last one. As we move to December, we move to a half. But I think the markets would still welcome some reassurance on that and some communication, some language from the Federal Reserve that we're now going to look at the data more rather than be so resolutely hawkish. There might be more reflection of the data. So equities could yet enjoy, you know, a nice run into the end of the year. We would sort of prefer US equities on the basis that that view could be wrong and there has some sort of defensiveness quality to it. But thereafter, I think if the labour market doesn't show signs of cooling, then maybe the Fed, you know, can't pause, maybe has to revert to hiking again, and then equity markets could be in a bit more trouble.
What do you think is priced in at the moment, Ben? I mean, one of the concerns, you know, speaking to policymakers, is that even if you look at the base case now for Fed, then we need repricing in bonds and equities, though.
Well, I mean, I think what's priced into the bond market is 3/4 in November, and then 0.5% into the end of the year, and then, you know, a couple, and then a pause, and then actually maybe cuts next year. So you might not actually. I think in the short term, I don't think equities have got that priced in. So if the Fed makes that pivot, then equities can enjoy that relief rally. If you do get that pivot, then I don't think bond markets move that much. But thereafter, if the Fed decide actually the labour market's still pretty strong and we're only going to pause, in fact we might revert to hiking rates, then that duration position, those longer bonds, could still be in a bit of bother. But I think equities can enjoy something of a relief rally from here on a Fed pivot.
All right, Ben, thanks so much. Ben Guttridge there from Invesco Asset Management. Now, coming up, Banco Santander Executive Chair Anna Botín weighs in on the turmoil in the UK, why she still has confidence in Britain. We'll bring you that exclusive interview next, and this is Bloomberg.
China's appetite for energy is enormous. The country consumes about 1/4 of the world's energy supply, 35% more than the US annually. Its energy needs have more than tripled since the year 2000. That consumption has helped to fuel astonishing growth, but it's come at a cost.
China is the world's largest greenhouse gas emitter. There is no way to tackle climate change unless China reduces its emissions to net zero.
The country's reliance on fossil fuels is also a hindrance to its own growth and the well-being of its citizens.
China is not energy secure. It has a massive import bill for things like oil and gas. It has a long-standing pollution problem, and it is also prone to outages that severely hamper industry.
All this has led the world's biggest polluter to take steps towards a radical transformation.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg. On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Welcome back to the Open. We are 23 minutes into the European trading day. You're seeing gains of 0.5% across the Stock 600. The US S&P E-minis pointing to gains of 1.4%. Nasdaq futures that ended up or around 3.5% yesterday, currently pointed to gains of 1.6%. And in your gilt markets, you're looking at some very, very modest selling pressure, just a 1 basis point move lower, higher, I should say, in terms of the yields on the 10-year and the 30-year, currently at 4.39. Of course, the Financial Times reporting that the BOE is pushing out its plans for quantitative tightening.
Now, Banco Santander Executive Chair Anna Botín has welcomed UK Chancellor Jeremy Hunt's decision to roll back most of the government's controversial tax-cutting plans. While speaking exclusively to Bloomberg, Botín called the moves steps in the right direction, and she also talked about the ongoing risks of high inflation.
We are a big lender in the UK. We're one of the top mortgage lenders and with a very low risk portfolio, 40% loan to value. But clearly what is happening in the UK is affecting consumers, is affecting businesses. But I'd say the world is living through a period of, I'd say, unprecedented economic stress added by, with the geopolitics and the national politics. What's really difficult at times like this for governments, but also for businesses, is to get the balance right between what's urgent and important, which is fighting inflation, but at the same time, making sure we're laying the foundations for growth. And of course, fiscal policy has to be aligned with monetary policy. And I think that is the balance that was not right in the UK. That's what markets were telling us. And at the end, it's about, and I'm very pleased by the steps that have been taken. I think it's important to give stability and confidence as much as we can, not just to markets, but to consumers and businesses. We're a big investor in the UK. I have high confidence in the strong institutions of the country. It's a very attractive place to do business, attracts talent from all over the world. So I think, the steps taken are in the right direction.
You talk about the global situation economically. I know you just come from Washington. You attended those IMF World Bank meetings. Give us a sense of the perception at Banco Santander of where we stand globally right now, because we have a lot of inflation around the world. We have a lot of central banks raising their interest rates, slowing economy, and also a war in Europe. How does that all come together? Because IMF is worrying about the possibility of a recession now.
Well, we're at levels of inflation we had not seen in decades, and we're also seeing government debt being at very high levels. So again, what's important, and this has profound implications for our customers, for consumers, for businesses, for society. And so getting that inflation down is really important. And, I like to say this is a disease that requires antibiotics. It's not going to be cured with vitamin C, right? And of course, you have the conflicting fiscal policies, and that's happening in many countries. And so making sure that they're not going one against the other is important.
Well, that was Banco Santander Executive Chair Anna Botín, of course, a huge presence here in the UK. Now, coming up, Biden downplays recession risks, but Bloomberg Economics recession probability model actually says a downturn under his watch is a near certainty. We also need to talk a bit about the midterm elections and, of course, everything that's going on in China, Tom.
Yeah, at a time on that inflation call, the economy call, of course, when the US is looking at further releases of its strategic reserves of petroleum. As they lead up to those elections, of course, inflation is central. Stay with us. This is Bloomberg.
So the inflation environment has been changing a little bit. Inflation's been very low for 25 years. Now people think inflation's coming back. How are you going to deal with that?
I think many of the tools that we've historically used to battle inflation no longer work in the same ways they used to. I think people oftentimes thought of housing as a way, or especially retail and real estate as a way to hedge against inflation. Less and less possible the way we've invested in it. I think commodities similarly have been thought of as a way to hedge against inflation. There are challenges over the long term. Equities have been a hedge against inflation. We will continue to do what we have done in the past, which is build a diversified portfolio where there are many different opportunities that have the possibility of hedging against inflation, because different types of inflation have to be hedged in different ways. So if it's a very quick increase of inflation as opposed to a slow rise of inflation, is it temporary? Is it a long or persistent type of inflation? So for us, I never model myself an economist that can predict where inflation is going. And so what I need to do is build a diversified portfolio where there are different options that can fight the different types of inflation, and to pay close attention to it. And you know, fundamentally, it's done through the equity markets.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Welcome back to the Open, everyone. 30 minutes into the European trading day, and here are your top stories. Crisis management. The UK Chancellor rips up Liz Truss's controversial economic plan as the PM apologizes for the chaos. The FT reports that the BOE could delay QT even further. Feeling upbeat, stocks extend a rebound after solid bank earnings from the U.S. and negative pressure on UK markets eased. Plus, sale on the cards. Credit Suisse considers selling its U.S. asset management business. Shares in the embattled Swiss lender open higher. Tom, if you look at stocks overall, they seem to be actually extending a rebound.
Yeah, there's the earnings optimism and there's the reduction of the UK financial risk after, of course, Jeremy Hunt, the Chancellor, ripped up 90% arguably of Trussonomics yesterday. The Prime Minister says she's going to cling on, hold on, and continue to govern up until the elections about 2 years out. We'll see if that actually happens. Across the benchmark, you're seeing gains of 0.6% in Germany. Pretty solid picture there. Gains of 140 points, up more than 1% over on the German benchmark. And the FTSE 100 gaining 0.8%, up 58 points. Again, on there's reporting as well from the Bank of England, from the FT, that the BOE will push out its QT. Last time I checked, there wasn't a lot of movement in gilts, but of course, we continue to focus on the politics of the UK, but also the earnings picture, and that has come out pretty solidly, particularly with the banks stateside. Let's move it on, see how things are playing out sector by sector then. Of course, the context as well is that the S&P ended up about 2.6% yesterday, the NASDAQ closing close to 3.5% higher, and the S&P holding up above this 200-week moving average on Monday, a key technical level for some, and potentially further support. Certainly Mike Wilson over at Morgan Stanley says there could be a bear market rally in the offing of maybe up to 13%. Technology gaining 1.3% in the session. Construction materials also up by more than 1%. At the bottom, there's just three sectors in the red, including basic resources and real estate, currently down 0.5%. Continue to watch, of course, what is happening in China, the Party Congress there, as well as further pressure on that real estate sector, what that means in terms of the demand for basic resources. Francine.
Now let's get straight to the Bloomberg Business Flash. Here's Laura Wright. Hi, Laura.
Hi, Francine. Credit Suisse is considering a sale of its U.S. asset management business. That's as the firm nears a strategy revamp that's likely to reshape its business and top ranks. According to sources familiar with the matters, the Swiss bank recently began the process to sell the U.S. operations. We're told the division is likely to attract interest from private equity firms. No comment from Credit Suisse. Bank of America shares jumped yesterday after the bank reported third-quarter results, with trading revenues holding firm. The bank also delivered strong net interest income with an increase of roughly 24%. CEO Brian Moynihan says the consumer is remaining resilient.
their credit quality, and the credit quality of Bank of America in our consumer books is very strong across the board. The payment delinquencies are much lower than they were pre-pandemic, much lower than they were in any average 5 best year type period. And yes, they moved a little bit off the floor, but they're still much lower than they've been. So consumers are spending, they have money, they're employed, you can see the unemployment numbers, and they have good credit.
That's the Bloomberg Business Flash. Tom, Francine.
Laura, thank you so much. Laura Wright in London. So let's get more on the economy. President Biden downplaying the chance of a recession, but Bloomberg Economics recession probability model suggests that a downturn on his watch is close to a certainty. Now, we're now joined by Vanguard Asset Management Chief Economist Jumana Salahin. Thank you so much, Jumana, for joining us. I mean, it does feel like everything is turning into a perfect storm in terms of inflation, maybe policy mistakes from the Fed and other central banks. Can the U.S. at this point really avoid a recession?
I think for this year, they probably will, because the data, the labor market data is still very strong. So I think this year, it probably can avoid a recession. Going into next year, obviously, as policy keeps tightening, we start to see that effect in the real economy, it will get harder.
Yeah, we were speaking to Ben Gutteridge of Invesco earlier in the show, and he said he sees a pivot from the Fed, possibly after a 75 basis point hike in November from the Federal Reserve. Is that something, a trajectory that you would see as plausible at this point, given the inflation dynamics that we're starting to see in the US?
No, I think we've got quite a different view. Our view is that rates are going to continue to rise into spring of next year, and we see the terminal rate above 4% now, the terminal rate being the rate at which interest rates will peak during this tightening cycle.
By above 4%, you see 4.6, the dot plots are 4.6% next year. Is that the level you're looking at?
Yes, we are. We're pretty much in line with the dot plot.
Jumana, in a previous life, you were actually head of division for financial stability at the Bank of England.
Yep.
I mean, how's the Bank of England handling this crisis here in the UK?
Well, I think it's been good. There were a few risks taken last week in terms of when Andrew Bailey said you've got 3 days left to sort things out, but that turned out in the end to be a good thing.
We've got this reporting from the Financial Times. They're going to push out QT again. It was pretty inconceivable that 1 week they're stepping in and buying bonds, the next week they're going to be selling them off again. This is a logical conclusion, surely, of the pressures that you're seeing in the gilt market. Do you expect that? I mean, does it make sense, first of all? And when can they step back in with QT, do you think?
Yeah, I think that's a really good question. I think there's some confusion out there on what QE, what QT, what these terms actually mean. And there's different types of intervention. There's the intervention that the Bank of England did recently to help the pensions market. That was a different type of intervention. It was more for financial stability reasons, but it looks the same, right? It looks, tastes, feel the same, but actually it's very, very different. The monetary easing type of QE, when you're actually intervening there to alter the slope of the yield curve, to bring yields down in the future, that's kind of monetary policy which you can't do when rates are at the zero lower bound. I do also want to say that central banks around the world, we don't actually know much about QT. We've learned a little bit about QE. We know when it works. It works best when markets are stressed. And with QT, the conventional wisdom right now is that it will work best when markets are calm. We can put that money back in huge balance sheets we're talking about, 30, 40% of balance sheets in Europe and the US. ECB 70% almost. And so these huge balance sheets need to be unwound at some point. We know that the best way to do that is when markets are calm. And that's not where we are right now.
But Jumana, there seems to be a fundamental problem in some of the analysis, and we've asked the Bank of England this many times, is that how much QT equals to a 0.5% interest rate increase? And until we really understand and know that, is there a danger of over-tightening?
I mean, that's a really great question, and that's something that Vanguard has been doing our own proprietary research in trying to map that. And that's what everybody's saying, what is this, what is this? And what we found is that, we sort of see that 80 billion of unwinding, which the Bank of England has said, that would be equivalent to about 30 basis points. So not much, but that's on the condition of markets are calm. When markets are stressed, those effects are much, much more amplified. And that's why they can't give you a good answer, is because we don't know much about how QT works.
Mark Cardmore from our LMI team was illustrating for us just how deeply negative real yields still are here in the UK, and the prospective then, or at least the prospect of pretty aggressive hikes from the BOE. But my question for you is, how much work is already being done in terms of inflation from what's happening in the energy sector across corporates and households, mortgage rates levels that they're saying, the cost of living crisis? That is surely taking some of that demand out that the BOE would be seeking to address.
Yeah, no, absolutely. High inflation erodes away the real spending power of individuals, their income. So when they go out to the shops, they can't buy as much, and therefore demand has to fall. So that channel is definitely in operation. The challenge, though, is that inflation is still at 10% and rising, and we've got to get that inflation down. So even though some of that impact is working right now, there is this battle between prices and wages, right? So if wages keep rising, you get that wage price spiral, and that will push you into the world that we don't want to be, the non-desirable world of high inflation, the high inflation era. And in order to get back to that low inflation, the world that we love, we want stable, predictable of 2%, we are going to need more rate hikes than inflation working its way through, because the signaling channel is quite important too.
But, Jemima, when's the right time then to beat hard action on some of these interest rate rises? And again, we're also hearing, for example, from a lot of the unions saying to workers, fight against austerity. So now we're in a bit of a policy limbo where we've gone away from Trussonomics, but actually unclear what we see and live through in the next 18 months.
I mean, I think what we're seeing now with the announcements yesterday is that fiscal and monetary policy are working more in harmony with each other, and that's a good thing. And I think going forward, we have to see there's still a few more announcements out there that we have to wait. What is the direction? What is the OBR going to say? So a bit more to play out.
We heard from the ECB's Villeroy, of course, of the Bank of France, saying that he sees a slower pace of rate hikes once 2% is reached, and some within the markets taking a bit of heart from that. Is that a trajectory for the ECB that seems feasible at this point?
Yeah, I think that's a feasible rate. So in the ECB, obviously, structural factors mean that our view of the neutral rate is lower. So we view the terminal rate to be 2.5% in Europe, whereas in contrast, what I said for the US and the UK, it's more above 4%. So yes, in the ECB, there's a slightly different trajectory given the structural, the fundamentals of the economy are different.
Okay. Jumana Salahin, Vanguard's Asset Management Chief Economist, thank you very much for all things BOE, Fed, and the ECB as well. Coming up, recession fears are growing, but such warnings are hard to find in Wall Street's results. A deeper look into the resilience that we're seeing, particularly within the banking space. This is Bloomberg.
Is it possible the industry is in an arms race that will lead to spending itself into an oversupply? I mean, that has happened before.
We've looked at this very carefully, and the digitization of everything. Tell me what aspect of your life, Emily, isn't becoming more digital?
Well, I'm trying to prevent that, but yes, I think it's happening.
And COVID has accelerated that. The industry crossed $500 billion last year, the semiconductor industry overall, and estimates are $1 trillion, a doubling by the end of the decade at that point. I believe those estimates. It's not that there's not going to be some blips and turns on the way, and the majority of that is driven by leadership process technology, of which only 3 companies can satisfy that need.
A lot's happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights
We think that's the next secular shift.
from businesses most influential and instrumental.
It's knocking it out of the ballpark.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio. From the world of politics to the world of business. Balance of Power with David Weston. News, analysis, insight from and about politics power players. Weekdays, this is Bloomberg.
Welcome back to the Open, everyone. 43 minutes into European trading day, and you can see a lot of the stocks are actually gaining. The CAC 40, we're expecting huge strikes in France, and yet the CAC 40 getting some 1.2%. Stocks definitely extending their rally when we have a lot more stability over on the bond market, but that is also buoying sentiment towards riskier assets. Now let's shift focus to U.S. Bank, who started reporting this week, Bank of America, the latest big lender, to paint a rosier than expected picture of the U.S. consumer.
Their credit quality and the credit quality of Bank of America in our consumer books is very strong across the board. The payment delinquencies are much lower than they were pre-pandemic, much lower than they were in any average 5 best year type period. And yes, they moved a little bit off the floor, but they're still much lower than they've been. So consumers are spending, they have money, they're employed, you can see the unemployment numbers, and they have good credit.
So let's bring in Bloomberg's Charlie Wells, our expert in all things finance. Charlie, I feel like, I don't know whether the pain is yet to come, because yesterday it felt like it was quite rosy, but actually then it's going to get worse in terms of cost of living crisis, is it not?
Yeah, it's sort of a wait and see approach, and at least if you see right now, it looks pretty good. So Brian Moynihan and Bank of America had a pretty good day yesterday. Net interest income beat expectations, $13.8 billion. The expectation had been $13.6. But when you look away from, this beneficiary of the Fed's higher interest rates, you also see trading doing pretty well. So we were expecting debt trading to do well, but also when you look at equities trading, that was expected to underperform, but it did less bad than you expected, so about a 4% drop. Compare that to JP Morgan, they had an 11% drop in the same period, so Bank of America, pretty good news there.
Yeah, I think was it Moynihan who said you had to squint to see any pressure?
It was one of those executives.
One of the executives, it was a lovely line. You had to squint to see any pressure on the consumer. Is Goldman going to continue this positive run? What are you looking for them from their results?
That's a good question, Tom. And look, Goldman reports in a few hours, and there's going to be a very big elephant in the room when they report, which is this potential restructuring. Now, we're seeing the bank potentially, bringing together a number of business units, investment banking and trading in one unit, asset management and wealth in another. And these are things that CEO David Solomon didn't want to do. We're seeing also the potential of that consumer banking unit effectively being disseminated sort of across the firm. And expectations there are low. This is a different type of bank. Revenue overall probably down 16% according to estimates. Fees from investment banking potentially down 54%. And this is a part of a big strategic problem that Solomon has, is he needs to try to bring that price to book ratio to a better place than it is right now, especially compared to his peers.
So we know not all banks are created equal. Can you break it down? Eventually, is it more the retail that's not doing as badly as expected, and some of the investment bank may be under pressure, depending on the pipelines?
Right, so yeah, they're the biggest banks, but they are so different, right? So some have these really entrenched consumer units, some are have been more focused on investment banking, have been desperately seeking, more regularized streams of revenue that they can get at any point in time. And what we really saw here was those banks that seem to have this reliance on the consumer, or at least a larger consumer segment, doing well. And it seems to speak, at least positively right now for the health of the American consumer. Credit card spending is continuing. It grew at some banks. We're seeing people able to meet those obligations. And also when you think about even things like car repossessions, which no one ever wants to have, Bank of America actually reported those were half the level that they'd seen in a very long time. So getting back to that question you asked first, Francine, what is the state of the American consumer cost of living crisis? It seems like in the U.S. consumer is holding up so far.
Yeah, those household balance sheets. Goldman Sachs arguably won't benefit from that as much. We'll look ahead to their results later today. Charlie Wells, thank you very much indeed. Credit Suisse, meanwhile, is considering the sale of its U.S. asset management business. That's as a strategy revamp approaches. Meanwhile, Middle East Sovereign wealth funds are said to be weighing whether to put money into the Swiss Lenders Investment Bank. Let's get more then from Bloomberg's global equity market senior reporter, Jan Patrick Barnett. Jan, what is the latest when it comes to Credit Suisse? It seems like a bit of a lifeline then for this lender.
Well, what we're seeing right now makes total sense to me because it goes into two directions that I guess investors want to see, and investors wanted to see actually in the earlier restructuring that Credit Suisse did, and they were disappointed. So the one thing is that they're going to focus on the wealth management core business, and that means that the investment bank has to go someplace else, and a sale there or a spin-off or whatever they want to call it makes the most sense, and that there are some people interested in going into this business makes also total sense to me. The other one, and this is kind of a European theme, I would say, is that the US business, European banks are struggling to get a big footprint there and go to scale. And we have seen that with Deutsche Bank a couple of years ago, retreating from that market. We have seen it with BNP selling the Bank of the West. And now it's Credit Suisse thinking about selling the US asset management. So again, that makes sense here to sell a non-core business where they probably struggle to make a big buck here.
JP, I mean, you speak to a lot of insiders and say it's a bit of a shipwreck also because a lot of the talents have exited. What happens to this bank?
Well, that is the big question. So what we want to see now is we want to see that as the management is sure and decisive on the restructuring, that they give the bank a new branding, so to speak, a new direction, and that is the foundation, I would say, to keep talent and to attract new talent. This will take time, so I'm pretty sure the bleeding will continue for a while longer. The reputation is bad. Working there probably is not the best atmosphere right now. So this will take time, but the first thing we want to see is give the bank a direction, give it confidence, and then you can build up talent again.
Thank you so much. Bloomberg's global equity markets. I'm losing my voice, Tom, because I'm so excited about some of the news stories, but that was a global equity market senior reporter, if I can get it out, Jan Patrick Barnett. Coming up, the UK Chancellor, Jeremy Hunt, rips up the script, scrapping most of Prime Minister Liz Truss's controversial economic program. We'll bring you the details, and this is Bloomberg.
Season is here.
Stock is bracing for another big earnings season.
Everyone is expecting it to be poor.
We've had big markdowns on earnings.
Bloomberg breaks the numbers first.
The bar has already been set pretty low.
The big question is, can it go lower? We're seeing some pretty bad earnings already from those who have reported.
With exclusive expert analysis.
Which aspects of the market are not sufficiently priced?
Is this a macro huge headwind? There is some really bright light at the end of this tunnel.
When is this floor going to come? When can I start buying?
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
The Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. SpiceJet chairman Ajay Singh earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. Celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Welcome back to the Open. 53 minutes into your European trading day. You're seeing gains across the benchmark of 0.8% here in Europe. Futures in the US point up by 1.6% on the S&P E-minis. Nasdaq futures, after posting gains of more than 3%, almost 3.5% yesterday, adding to that today with the futures looking up by 1.8%. That's for the tech-heavy index, of course. Keeping an eye on what's happening in the gilt markets in the UK after the FT reported that the Bank of England will be pushing back its QT program. This, of course, after the new Chancellor, Jeremy Hunt, ripped up Tresonomics yesterday in the Houses of Parliament. Currently, there is a little bit of a move into gilts at the front end, 356. That's a move lower by 2 basis points. The all-important 30-year at 436. That's a move lower by 1 basis point. So a sense of, at least for now, some stability within the gilt markets. The context, of course, is that you're nowhere near getting back to levels pre-mini budget when the 30-year was at about 3.5 or thereabouts. Currently 436, lower by 2 basis points on the 30-year. Okay, let's get the Bloomberg First Word news now with Laura Wright. Laura.
Thanks, Tom. In the UK, Liz Truss has apologised for her mistakes but vowed to remain Prime Minister for the national interest. It comes after the new Chancellor, Jeremy Hunt, reversed most of her economic plan. It leaves Truss in office but without the power to proceed with her tax-cutting agenda.
Now, I recognise we have made mistakes. I'm sorry for those mistakes, but I've fixed the mistakes. I've appointed a new Chancellor. We have restored economic stability and fiscal discipline. And what I now want to do is go on and deliver for the public. We were elected on the 2019 manifesto. I'm determined to deliver on that.
In Germany, Chancellor Olaf Scholz has ordered an extension of the country's 3 remaining nuclear plants until April 2023. The decision is designed to end the standoff between his 2 coalition partners. The Greens are ideologically opposed to nuclear power, but the business-friendly Free Democrats argue Germany should use all the generation capacity available to tackle the crisis. Britain's reversal on its controversial tax-cutting plans are a step in the right direction. That's according to Anna Botin, the chair of one of the UK's leading lenders, Santander. She says it's important to give stability and confidence, not just to markets, but to consumers and businesses.
We're a big investor in the UK. I have high confidence in the strong institutions of the country. It's a very attractive place to do business, attracts talent from all over the world. So I think, the steps taken are in the right direction.
Chinese junk dollar bonds have dropped to a record low. That's as the property crisis is showing few signs of improving. The notes are denominated by real estate firms, and the average price fell below 56. It hit that level before in August, before government support fueled a rally. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Tom, Francine.
Laura, thanks so much. Laura Wright in London. Now,
checking back in the markets, yeah, he's doing gains, still at 0.9%. So you have that diluted risk when it comes to UK financial markets, but the earnings are coming in pretty solidly as well, Francine.
Yeah, so the hour flew by, but I actually also woke up this morning thinking it was Thursday, so God help us all.
Francine's already at Thursday. Do you know what the second red story is on the terminal? It's Patek Philippe launching a $70,000 watch. It's the reference 5811. 18-carat white gold stainless steel. That'll take your mind off the market volatility. Plenty more coming up. This is the European Market Open Surveillance Early Edition up next. This is Bloomberg.
I started, I had no idea it was going to turn into this, which is a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it, building it, building it. You gotta think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual. I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
Part of what I love about business is you get to build things from nothing.
I don't have any investors. All this is all money in. This is me just building it.
It's pretty much full-service shadow banking with nobody in charge.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology.
Welcome to Bloomberg Crypto.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. Just checking the markets here. I'm Francine Lacqua here in London, and here's what's coming up on today's program. Crisis management. The UK Chancellor rips up Liz Truss's controversial economic plan as the PM apologizes for the chaos. The FT also reports that the BOE could delay QT even further. Feeling upbeat, stocks extend a rebound after solid bank earnings from the U.S. and negative pressure on UK markets eased. Plus, sale on the cards while Credit Suisse considers selling its U.S. asset management business. Shares in the embattled Swiss lender open higher. Now, first thing is first, let's check in on the markets. And we did see quite a lot of these markets actually continuing to be buoyed. A lot of these stocks extending this rebound. This is as the UK efforts to foster greater stability in its volatile bond market seems for the moment to be working. I'm looking at European stocks overall. They're extending gains. S&P futures also gaining some 1.7%. We had encouraging figures from Bank of America. Also, the words that came out of the Chief Executive Officer, Brian Moynihan, pretty encouraging. The U.S. 10-year yield, 3.9798. We have a great read with Mohamed Arian saying that because of the lack of accountability of the Fed, we should look at the 4 errors that they made and look at its independence. Finally, this is a picture across the board when it comes to European maps. So European stocks are up. A couple of stories that we will be covering for you. Of course, the UK. Our Lizzie Burden is outside number 10, and then the CAC 40 gaining 1.2%. Huge days of strikes in France because of course, the energy crisis over the next couple of days. Now, the UK Prime Minister, Liz Truss, has apologized for the chaos caused by her mini budget, but she says that she plans to lead the Tories into the next election.
My message is we should be focusing on delivering for the British public. We are in difficult economic times. We're in difficult international times with the war being perpetrated in Ukraine. And now is the time to focus on delivering, making sure that we are delivering on our energy package. So before we stepped in, people were facing energy bills of up to £6,000. We've now put in place the energy price guarantee. We've reversed the national insurance increase. And that's what I'm thinking about as Prime Minister.
Now for more, we're joined by Bloomberg's Lizzie Burden. Lizzie, I know you've been working nonstop. I don't know if you've had any sleep over the last 3 weeks. Has the new Chancellor, Jeremy Hunt, done enough to stabilize the economic situation, to shore up Truss's position?
Well, I have to say, he's done an awful lot in a day, hasn't he? And it's hard to, and Bank of England and the Treasury, But on the other hand, without the sugar rush, the recession risks are heightened. And even though Hunt has pretty much nuked Trussonomics, he's still got to pay the moron risk premium, as T.S. Lombard puts it, and that has a cost. Our economists say that borrowing is going to be £10 billion a year more expensive by 2025 because of the damage Truss has caused to the UK's economic credibility. And so one guest on Bloomberg TV yesterday defined Huntonomics as Sunakonomics on steroids. And in a sense, it has to be, because Hunt needs to be more fiscally disciplined. He's going to have to find spending cuts to make up for what's come before. And Labour is dubbing this austerity 2.0. It's difficult politically. He's also appointed Rupert Harrison from BlackRock as an economic advisor. It's a tricky link optically because Harrison was George Osborne's right-hand man in the austerity years. No matter how respected he is in markets, no matter how welcome it is that Truss is finally acknowledging the need to listen to the economic orthodoxy. So it's going to be a scary political path leading up to the Halloween budget.
So the Prime Minister seems to be hanging on by a thread. Are there any realistic contenders to replace her, Lizzie, or is there an understanding that actually they can't coalesce over one single person so she stays in power for a bit longer?
But what a reason to keep a Prime Minister in number 10 Downing Street. It doesn't exactly underscore a powerful Prime Minister. Yesterday in the Commons, it seemed almost like an audition by the various members of Truss's cabinet for the top job. You had Penny Mordaunt, the leader of the Commons, standing in for Truss. She had to explain that Truss was not, in fact, hiding under a desk. Then you had the various appearances from Jeremy Hunt, the new Chancellor, and conspicuously absent was Rishi Sunak, the former Chancellor, who many are hoping will step back into the fray and take over. Really, it's not just a question of who would take over, but how they would take over without bringing about a general election, which none of the Tories want, given that the Labour Party now has a 25-year record poll lead over the Tories. But what I'm hearing in Westminster, an interesting argument to square the circle that Sunak could make, is that he was Johnson's Chancellor. Johnson was ousted more for conduct reasons than policy reasons, so perhaps Sunak could try to draw on Boris Johnson's 2019 landslide election victory mandate.
Lizzie, thank you so much. Lizzie Burden there, of course, at Westminster for us. Now, we're also joined by Elise Bedois, head of EMEA Equity Research at Citi. Elise, thank you so much for joining us. I mean, what a whirlwind we've had in the UK over the last 2 to 3 weeks. Is there anything that looks attractive? I was going to say, are you going back into some of the UK assets right now?
Good morning, Francine. Well, I think, if we take a step back in what's happening in the UK, the market has taken a view, certainly, a relatively negative view. And the idea is, the question our economists were asking is, is essentially, are the UK disruption a template for something more severe globally? And I guess we've had a sense of relief yesterday with at least on the face of it, fiscal policy seeing more inadequation with monetary policy. In terms of what we're looking at from an equity markets perspective, we still expect, gains by the end of 2023, but meanwhile, some volatility. How we would look at equity specifically, of course, we remember that the UK market specifically is not a direct link to the UK economy. It's the UK stock exchange is obviously made up of a large number of multinationals, and it's the same for the European market. So what we favor at the moment, our key targets are, we have now will move to favor defensives over cyclicals. Remember, at the beginning of the year, we were really worried about real yields and the impact of their rise on equities. Really now, we're, if there's any issues with equities, we're really worried about downgrades to estimates and to EPS. And remember, we're in full Q3 results season. So we're really favoring defensives versus cyclicals, and we can go into sectors in a minute.
So is there anything, Elise, first of all, and I don't know whether you do it, thematically or actually country by country, if interest rates rise very quickly like they have so far, but that gets accelerated, what are the parts of the markets that are over-leveraged? And so what does that mean for your exposure to, equities that could have ripple effects or that could be invested in those? So second round effects.
Yes, I mean, interest rate rise in general, we really look at the rise of real yields, and so we adjust interest rate rise for inflation. And that correlation has played out already, and there's less worry about that. You're right to point, obviously, issues around leverage, and, sector by sector, we're going to now, have to look at that, and the market is certainly starting to price that in. I don't think there's any particular sector that actually is over leveraged at the moment. That's not something that we've looked at, but it's going to be within each sector. We're going to move towards more stock picking and really looking at those balance sheets. I think really, again, I would look back at defenses versus cyclicals, and we're really favoring, for example, right now, multinationals with a broad set of earnings that can fend off notably certain currency weaknesses and benefit from a strong dollar. So particularly in Europe, that's going to be luxury goods, for example, a very, very nice sector because it's got very strong growth still coming in, and it's a sector that has massively derated. We're going to favor, of course, the traditional defensive like healthcare and telco.
Yeah. So, Elise, we're just getting a headline saying that the UK Prime Minister Truss's net favourability has slumped to -70. This is in a YouGov survey. This is pretty much the approval rating of the current Prime Minister, Liz Truss. I know, Elise, it's difficult to quantify what that means for future economic policies or earnings across the road. But where do you see the pound headed? I know weakness in pound because of the overseas exposure to a lot of these companies, as you said, have just made it very attractive.
Yes, so let's take a step back and pick the various elements. Political instability, markets have had to compose with that for a while now. Again, I think the UK is only another test for the many vulnerabilities we could see in the market, and it's been in focus. We've had a bit of relief with the announcement, but the flip side of these announcements is obviously there's considerably less economic support than last week for the UK. And just this morning, our UK economist has downgraded his GDP forecast to 1.6% recession next year versus the original 0.5. So obviously there are implications. In terms of the pound and where we see it headed, at Citi we continue to forecast strong dollar. So obviously all our forecasts and all our picks are based on that. So again, in terms of stock picking, we would continue to favor, as I say, large multinationals, and the UK market specifically, again, is composed of much of that. It's derated significantly. It's trading at 9 times. I think eventually, you can get good exposure there. Remember, there are some challenge sectors as well. We continue to believe that the retail sector, particularly in the UK, will be very challenged. We are way below consensus on the retail sector.
Elise, thank you so much. Elise Badouader, head of EMEA Equity Research at Citi, stays with us. We'll talk a little bit more broadly also about the situation in France and Italy. Coming up, the Santander Executive Chair, Anna Boutin, weighs in on the turmoil in the UK and why she's still confident about the UK. We'll bring you that exclusive interview next, and this is Bloomberg.
COVID has changed everything. People are changing the way they work and the way they travel. Can you explain what you mean?
I think the world is never going back to the way it was fully before the pandemic. And one of the changes, I think, David, has been a change in how we work. Many people had a job at an office. They're not going to be required to come back to the office 5 days a week. And I don't think CEOs per se are going to determine these policies. I think workers will, because all of us CEOs, I think, want the best talent. And I think flexibility is going to be the second most important benefit after compensation. All of this, David, has culminated in Airbnb not just being a company about traveling, but now a company about living. So there's this whole new category of travel that's not classic 2-3 nights in a city. It's not long-term housing, and it's completely emerged because of the pandemic.
When U.S. inflation numbers are released,
The score is inflation won, Fed nothing today.
Bloomberg brings you crucial data at terminal speed.
Core CPI in America, 40-year high.
Yields are absolutely flying.
Equities down and down hard.
It's ugly.
And instant expert analysis.
What is the makeup of this inflation?
We are watching the underlying fundamentals.
Will they go 100 basis points?
The downshift just keeps getting pushed out. Now it looks like we're going into extra innings.
Nobody covers the economy like Bloomberg, your global business authority.
We are a big lender in the UK. We are one of the top mortgage lenders, and with a very low risk portfolio, 40% loan to value. But clearly what is happening in the UK is affecting consumers, is affecting businesses. But I'd say the world is living through a period of, I'd say, unprecedented economic stress added by, with the geopolitics and the national politics. What's really difficult at times like this for governments, but also for businesses, is to get the balance right between what's urgent and important, which is fighting inflation, but at the same time, making sure we're laying the foundations for growth. And of course, fiscal policy has to be aligned with monetary policy. And I think that is the balance that was not right in the UK. That's what markets were telling us. And at the end, it's about, and I'm very pleased by the steps that have been taken. I think it's important to give stability and confidence as much as we can, not just to markets, but to consumers and businesses. We're a big investor in the UK. I have high confidence in the strong institutions of the country. It's a very attractive place to do business, attracts talent from all over the world. So I think, the steps taken are in the right direction.
Well, that was the Banco Santander Executive Chair Anna Botin speaking exclusively to Bloomberg about the turmoil in the UK. Now we're back with Elise Badois, Head of VMEA Equity Research at Citi. Elise, we talked extensively about the UK. You were giving me some of your sector calls, what you like and don't like. How do you break it down country by country in the rest of Europe?
So in the rest of Europe, I think, again, obviously in France, you've got a nice cluster of luxury goods companies, and, we continue to expect strong growth there. We think that has derated, and that's probably a nice place to invest going forward, even for US investors where, that growth might, offset some of the FX strengths there. We continue to expect strengths in healthcare and in telco, where we have stable earnings that are a very good hedge against the GDP downgrades that we might see. Obviously, we are into earnings season, and we may see some bottom-up. We may get some bottom-up information. Investors in Europe have been, overwhelmed with macro news, with obviously political turmoil, and meanwhile, we have that bottom-up information that will come up in the next few weeks. We believe, we'll still see weakness probably in chems, in some of the industrial names, not all of them, and then in utilities.
So, Elise, I don't know whether, I'm sure you're looking at the strikes in France, and I don't know whether that changes economic policy, and then further down the road could actually change your view, for example, on French equities.
So I think it's very important to not ignore certainly those disruptions. Essentially, when we look back in the last 3 years, we've seen massive shocks to our supply chains. The global financial crisis was a credit crisis essentially, but this time around, all the troubles that we've seen and the vulnerabilities have come from supply chain shocks, effectively. So the disruption that you highlight in France could bring some supply chain shocks again. France has been spared when you look at our GDP forecast at Citi. We have some countries dipping into recession, but France actually is somewhat spared versus Germany, Italy, and the UK. Clearly, we'll be watching developments, and the resurgence of, say, the Gilets jaunes or any form of disruption is something that we should watch.
Elise, is there anything out there in what you see for earnings that could make you change your view about what you've just beautifully laid out?
I think, there's some positive scenarios as well. I mean, obviously, our global economists have put out a piece recently where we looked at a number of scenarios. Our best case is for essentially a couple of world economies dipping into recession, but not all at the same time, so not synchronized recession. I mean, we have a bear case where we all go synchronized recession, and we have a bull case, actually, where, things could ease out. I think what could make ourselves change, and obviously any change in the war in Ukraine, because that's the investability of the European sector from abroad, and fund flows have pretty much halted, and that would be a big change. So we're obviously watching geopolitical development with great interest. I would say that's the biggest change, and then any indication of when inflation may or may not peak. From a bottom-up perspective, I would highlight the level of inventories and stocks. For example, our industrials analysts have recently very much highlighted the greater stocks and the length of stocks for industrials, which is actually helping producing good Q3.
Elise, thank you so much, as always, for joining us. Elise Badois, their head of EMEA Equity Research at Citi. Now, we'll have plenty more, of course, on the markets. We also have the Bloomberg Equality Summit today here underway at European headquarters in London, virtually as well. The summit will convene business leaders, policymakers, and innovators and task them with creating a blueprint for a future based on equitable prosperity. Well, some of the speakers include Luke Ellis, Man Group Chief Executive, Anne Richards, who I think is on stage right now from Fidelity International, where she's Chief Executive, Julia Hoggett, LSE Chief Executive, and Matt Hammerstein, Barclays UK Chief Executive. For more information, just type LIVE GO on your Bloomberg terminal. This is Bloomberg.
China's appetite for energy is enormous. The country consumes about a quarter of the world's energy supply, 35% more than the US annually. Its energy needs have more than tripled since the year 2000. That consumption has helped to fuel astonishing growth, but it's come at a cost.
China is the world's largest greenhouse gas emitter. There is no way to tackle climate change unless China reduces its emissions to net zero.
The country's reliance on fossil fuels is also a hindrance to its own growth and the well-being of its citizens.
China is not energy secure. It has a massive import bill for things like oil and gas. It has a long-standing pollution problem, and it is also prone to outages that severely hamper industry.
All this has led the world's biggest polluter to take steps towards a radical transformation.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials, find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Credit Suisse considering the sale of its U.S. asset management business as a strategy revamp approaches. Meanwhile, Middle East sovereign wealth funds are said to be weighing whether to put money into the Swiss Lenders Investment Bank. Let's get more from Bloomberg's Tom Metcalf. Tom, first of all, I mean, how bad is the situation at Credit Suisse? I know there's huge people, big rainmakers actually leaving the bank, but we're not really talking about solvency, are we?
No, it's not that extreme, but I think you can see how sort of all-encompassing this is just by the steady flow of news we're seeing. Obviously, we've got this big strategy revamp announcement coming on October 27th, so late next week. But what we're expecting is just a slew more of news come through as this sort of drip feeds out.
So are we expecting them to break up the bank?
Certainly we're hearing, basically it seems that so many options are under consideration, right? So yesterday we had the news that the US asset management might be up for sale. You've heard the Middle East investors sniffing around certain bits. Certainly seems that could be a possibility, which, sort of makes sense given the news in the last few months or even years, but it's almost unfathomable. Someone who knows Credit Suisse, back in pre-financial crisis, extraordinary, really.
Yeah, even 4 years ago. I mean, you wouldn't really expect back then to be here now. So is really everything on the table of what they could do?
Yeah, look, I think that's the fairest assessment, and it'll be really interesting to see how they sort of word this sort of announcement on October the 27th. For the last however many quarters, they've been trying to sort of steady the ship. And, I'm expecting sort of big fireworks, really big statements, and there's sort of an idea that, with one big effort, they'll sort of set out their plan and move on, hopefully.
Tom, what's valuable in the company? So is it the brand name in certain parts in Asia? What's the best option?
I think sort of the wealth unit is probably the sort of the most cherished part of the business right now. But, even the investment bank, which has gone through so many troubles, that is a storied franchise, It comes out of First Boston in the US, and you'd think there'd be some interest there. There's still a lot of talent there, but of course the problem is it's like a trust business, right? And as you say, big rainmakers have been leaving. They're doing everything they can to try and keep talent. And then yesterday we hear that Christian Messner, the head of the bank, is off as well.
Tom, thank you so much. Bloomberg's Tom Metcalf. Coming up, Biden downplays recession risks. We'll talk, of course, about the economy and the risk of inflation going up. This is Bloomberg.
Is it possible the industry is in an arms race that will lead to spending itself into an oversupply? I mean, that has happened before.
We've looked at this very carefully, and the digitization of everything. Tell me what aspect of your life, Emily, isn't becoming more digital?
Well, I'm trying to prevent that, but yes, I think it's happening.
And COVID has accelerated that. The industry crossed $500 billion last year, the semiconductor industry overall, and estimates are $1 trillion, a doubling by the end of the decade. at that point. I believe those estimates. It's not that there's not going to be some blips and turns on the way, and the majority of that is driven by leadership process technology, of which only 3 companies can satisfy that need.
To the world of business. Balance of Power with David Weston. News, analysis, insight from and about politics power players. Weekdays, this is Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
Crisis management. The UK Chancellor rips up Liz Truss's controversial economic plan as the PM apologizes for the chaos. The FT reports the BOE could delay QT even further. Feeling upbeat, stocks extend a rebound after solid bank earnings from the U.S. and negative pressure on UK markets eased. Plus, sale on the cards while Credit Suisse considers selling its U.S. asset management business. Shares in the embattled Swiss lender open higher. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Bank of America reported record net interest income of $13.8 billion in the third quarter as it reaped the benefits of rising interest rates. The chief executive, Brian Moynihan, told us consumers are still spending, and he's seeing few signs of weakness or stress in the U.S. economy.
Are the consumers spending? Are they doing things that drives the U.S. economy, as you well know? And so the spending for the third quarter was 10% higher than it was last year's third quarter. The spending for the first couple weeks in October is 10% higher than it was last October for the first 2 weeks. Now, what we told people was you're seeing it slow just a hair. So it was maybe 14, 15% early in the year, 12, and now 10, which is frankly what people are trying to do is get the spending down a little bit, get the inflationary pressures down and the drag of the interest rates, but it's still strong. And then so that's one way to think about it. The other way to think about the consumers, do they have money in their accounts to spend? And in the month of September, the account balances were flat or slightly over where they were in August. And that is multiples of where they were pre-pandemic, and they continue to hold their own. And you can see inside the cash flow in customers, not making any reflection on this is tough on certain customers, others, but even when customers have lower income levels, we can see them cash flowing positive still. Rent increases could slow that down, other things could happen, but the core thing is, as of the third quarter, they continue to cash flow and they continue to have more money in their accounts than they did before the pandemic by multiples. And then you go to their credit quality, and the credit quality of Bank of America in our consumer books is very strong across the board. The payment delinquencies are much lower than they were pre-pandemic, much lower than they were in any average 5 best year type period. And yes, they moved a little bit off the floor, but they're still much lower than they've been. So consumers are spending, they have money, they're employed, you can see the unemployment numbers, and they have good credit. And that's good news for America, but it also makes the Fed's jobs tougher because they're trying to slow down this American consumer, which is a very resilient thing.
But just to make sure I understand it, and obviously you can't promise what's going to happen next year. I'm not asking you to do that. But a lot of economists are saying the reason consumer is so strong right now is because the balance sheet were so strong coming out of the pandemic. At this point, you don't see those balance sheets really turning down as we get into next year.
We don't see it yet. And so if you look back 2 quarters ago when we did the earnings call, people are like, oh, the consumer is getting knocked out of the game, they're spending their accounts. 6 months later, the money's still there. So I think people are over-anticipating the future. We, as our projections, Canada Balance Plot, and the team in our research group, which is one of the best in the world, has the third quarter positive, the fourth quarter negative, the first quarter negative, the second quarter of 23 negative, and the third quarter of 23 negative, albeit at like a 1 to 1.5% GDP annualized growth rate, negative growth rate. So we are predicting a shallow economy. That's our core assumptions. And embedded in that, if you look at how we set our reserves, we have the assumption that we're going to have 5.5% 4.5% unemployment. I'm not sure that's going to happen, especially this quarter. We have it at 5%, but that's the conservatives when we build our balance sheet from an operating basis. But if you look at the consumers, there's not the signs that we see in our numbers or other people's numbers, quite frankly. It says they're slowing down yet or they're in stress yet. And that will have to be part of what happens in order for there to be a deep recession, because if the consumers have money in this big consumer-driven economy, that's what keeps America strong.
Brian, you've always taken great pride in the Bank of America research unit and how good they are. Let's assume their numbers are exactly right. It could be better, could be worse, exactly right. 3 down quarters, 5.5% unemployment. What does that do for your loan loss provisions? What kind of provisions do you have to make for that?
Well, inherently, we're always discounting the future because the way the CECL rules work, so-called, you look out for the life of loans. So you build reserves, and we built $400 million or so this quarter, which is building that scenario, which is 60% to the base case, which is the average of blue chip economist, and 40% to an adverse case. And when you blend that together, it implies those adverse cases have high inflation and have high unemployment in them. And you blend it together, the core, what we did at the end of the third quarter, has 5% unemployment for the fourth quarter of 22 and more than like 5.5 for next year. So it's very conservatively built. So your provisions will go up against that backdrop. At one point, you'll start to see the other side of it emerge, and that's what it sort of happened back in the pandemic. We put up a lot of reserves, and we took them back in once you saw that the impact of, because what the administration did and what Congress did and what central banks did around the world, you actually mitigate the effects of the unemployment numbers. That won't happen in a standard recession, I would expect. But on the other hand, the consumers are going in much stronger shape than they did even in 2006-07, leading into the great financial crisis.
That was the Bank of America Chief Executive Brian Moynihan speaking with our very own David Weston. Now we're joined by Octavio Marenzi, founder and Chief Executive Officer of Oppimas. Octavio, great to speak to you today. Now, not all U.S. banks are created equal. Why is Bank of America doing so well, and why are we actually onto a third possible turnaround plan for Goldman Sachs?
I guess if you look at the sort of U.S. banking landscape, those banks that have a big foot in commercial lending and corporate banking and retail banking have done really well this quarter. Or I think really well, relatively well. The revenues are up a bit, profits are down a bit, but I think you can explain that away by basically saying these banks are squirreling away money in anticipation of some sort of downturn, in anticipation of credit quality worsening in the coming months and coming year or so. But we haven't seen any evidence of that yet. As Bill Moynihan pointed out, credit quality remains absolutely outstanding in sterling. So default rates, delinquency rates are very, very low. But these banks are pushing money away nevertheless. So there was a big increase in revenues overall, sort of high single digits, 10% increase in revenues overall for banks like Bank of America, and a bit of a decline in terms of overall profitability. If you look at sort of the investment banking side of the house, things look a bit worse there. So investment banking activity itself has dried up, especially on equities. Equities capital markets have basically disappeared altogether. And on the trading side, a bit lackluster. Some improvement, some worsening there.
But so, Octavio, give me a sense of what are your favorite banks right now? We also see, and I'm looking at some of the data released, for example, by the Fed about how much of the consumer lending a lot of these banks have on their balance sheet.
Well, I think the banks that look really good at the moment are JP Morgan, are Bank of America, amongst those sort of retailish banks, Citigroup to a certain extent as well, and then a bit weaker banks like Wells Fargo. Wells Fargo, bear in mind, has a very large mortgage portfolio, or a disproportionate large mortgage portfolio, and the real estate market is one that's suffering. So we've seen a drying up in terms of demand for mortgages. That's hit Wells Fargo harder than the others, relatively speaking. So that one is looking a bit weak. And then you've got the two big investment banks, Goldman Sachs and Morgan Stanley, who, compared to those sort of more retailish banks, are struggling a bit and are trying to find their way, particularly in a new investment banking landscape. So that's, I think, how things break down amongst the top 5 or 6 banks in the US.
Octavio, what are the banks that will suffer the most going forward if we have a big cost of living crisis and if inflation soars by another 2 percentage points?
Well, I think these big, the big sort of commercial banks, the big money center banks, have benefited enormously from a big increase in their net interest margin. So they are getting more on their loans than the money they're lending out, and they're not paying more yet for the deposits. So if you look at the balance sheets and income statements for these banks, their depositors are still willing to accept very, very low interest rates and basically nothing on their checkings accounts and savings accounts. As interest rates push further, these banks aren't going to be able to do that anymore. So short-term interest rates have risen quite aggressively over the course of the past year. They're going to have to pay their depositors more. So that's going to come down. So then we also start to potentially see more of a housing crisis actually start to develop, and housing starts to look very, very bad indeed. It's already slowed down enormously. I think prices are going to come down there pretty hard on the housing sector in the US, and that's going to hit those banks with big exposures there. So those are sort of the storm clouds gathering on the horizon a bit.
Octavio, talk to me a little bit about some of the European banks. So there's, you know, a lot of stress and a lot of concern about what Credit Suisse ends up being. Is everything on the table right now in terms of being split off, being sold, sovereign wealth funds maybe coming in?
Well, they're talking about selling off their U.S. wealth management, asset management business. They're talking about selling off some participations that they have in Switzerland, some sort of tangential kinds of things like their stake in the Swiss stock market in SIX and a few other sort of card processing companies there in Switzerland. So they're still tinkering a bit at the edges, I think. But I think at this stage, everything's on the table. This is basically a bank that has stumbled from one crisis to the next. It's been a bit embarrassing to watch. And they're finally getting around to doing something quite dramatic about it. I will say about a year and a half ago, it looked like Credit Suisse had turned the corner. Things are looking pretty good, and you said really the new CEO has turned things around and things are looking in a positive direction. And then basically the wheels fell off the wagon again at Credit Suisse, and they're back sort of scandal-ridden, stumbling from one crisis to another. So I think at this stage with Credit Suisse, everything's on the table, basically selling off parts of their core business, basically selling parts of their wealth management, their asset management, their investment banking arm, things of that sort. I think it's all on the table. We're going to see this bank basically get dismembered over the course of the next 6 to 12 months, I believe.
Octavio, thanks so much for joining us. Octavio Morenzi, their founder and chief executive of Opimas, joining us this morning on all things U.S. banks, but also Credit Suisse. Coming up, the chief executive of Kurt Geiger tells us how the fashion brand is trying to maintain demand with soaring inflation. This is Bloomberg.
When I started, I had no idea it was going to turn into this, which is a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it. You gotta think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual. I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
I think the key problem here is that this inflation is caused principally by supply side considerations, by supply forces, and that means you have to really hit the interest rate sensitive part of the economy very hard in order to realign aggregate supply and aggregate demand. So the cost is going to be much higher than you would typically see in a normal business cycle, and that's going to be the challenge. And until the market knows how the Fed's going to deal with this trade-off, or how central banks generally are going to deal with it. I think the market remains on guard and remains unsettled.
And what's been priced in from what you're seeing from asset classes right now, the prices we're seeing right now, because we have the likes of Mark Mobius saying that, you know what, rates could go as high as 9%.
Well, you know, this is sort of the game that every week we seem to be pushing rate expectations higher. At the moment, I would say we're probably looking at a kind of priced-in end rate of somewhere close to 5%. And to the extent that there is uncertainty on that, that's what keeps the market on its toes.
And we said earlier that BlackRock sees market recovery longer than other economic downturns. Why is that? Number one, when might that be? When will we see bottom? What might be the trigger?
Yeah, the key reason is because this inflation is driven principally, as I said, by supply-side forces, and that means the Fed just has to be, or all central banks have to be that much tougher if they want to get inflation back to 2%. It really means, you know, you need to crush the interest rate-sensitive part of the economy if you want to realign this quickly and get back to 2%. And I think this is where the debate is. Is it worth the price of doing that to get inflation back to 2%, or do you at some point have to say the cost is too high and you have to tolerate some inflation while you let the supply side heal? That's the question the Fed will face at some point early next year.
And in the meantime, the dollar at 20-year highs, it will remain elevated for quite some time. How long do you think that will be, and where's the biggest pain that we'll see from that mighty dollar?
Well, I think first of all, this is very hard for emerging markets. That's clear. It's going to be hard for the U.S. economy. It's hard for the world economy as a whole. And then the question comes, as you tighten policy, whenever we have a cycle, and remember, this is the most aggressive tightening cycle we've ever seen already at this stage. And that raises the question of what else appears of vulnerability points in the financial markets, in the financial sector. And as we've seen, LDI in the UK has been one flashpoint. And I think the market rightly worries, will there be others as we proceed on this very aggressive tightening cycle?
There with BlackRock Vice Chair Philip Hildebrand saying markets will remain uncertain for quite some time, with the strong dollar also set to linger. Now, that strong dollar has benefited quite a few European retailers, with American tourists taking advantage of the weaker pound. Well, Kurt Geiger is known for designer stilettos, but the retailer has inflation hot on its heels. Let's discuss the company with the Chief Executive, Neil Clifford. Neil, thank you so much for joining us.
Welcome.
Now, you were explaining to me something that I had, of course, seen in the research, but you kind of brought it home, that in the last 3 years, you've been betting much more on the U.S. A stronger dollar must help a lot with that when you bring the revenue back home.
It does. I mean, we adore America as a company. We've been there now 5 years. Yeah. We were very lucky to recruit an amazing executive to help us with that expansion. And now we have more doors in America, more points of sale than in Europe and the UK. So 400 points of sale in America.
So, I mean, the U.S. market is definitely the biggest retailing company in the world in terms of how much they consume. Is that why you like America, or do you think that U.S. consumers' spending will be stronger than here in Europe going forward?
Well, we always knew that America would be a great expansion opportunity for us, and the keys really were recruiting a team and to help us with that, to give us the confidence, frankly. And yes, America next year will be bigger for us than in the UK. So we're very fortunate that it's been a big success.
I mean, I think 40% of your sales are still in the UK. How much of a mess is Great Britain right now?
How much is, sorry, what was the question?
How much of a mess? I mean, I don't know whether you can find the staff in your shops. I don't know whether inflation is biting much harder than in other places.
We are still growing. We are still growing. Our sales are up on last year, and our profits are well up on last year in the UK, be it that, you know, the market and the consumer is under pressure. So I suppose it just makes us work harder. We're a culture of a company that looks in the mirror much more than out of the window. So it just motivates us to do a better job, frankly.
But how do you do a better job? So is it the better quality of products?
Design, price, value,
but price,
service.
you need to bring it down or up?
Well, maybe in some areas down slightly, but it's more about value than price. It's more about ensuring that we design things, we create things that are unique. I know that sounds a little obvious, but yeah, that's our job, really. No retailer has the right to survive or succeed or fail. It's up to us to be motivated to do a better job every day. But yes, the US for sure is a place where I'm there maybe 1 week every 6 now. I'm there next week, for example, looking for store locations. So we're very positive about that part of our business. Yeah.
So, Neil, how much do you worry if you look at the next 4 to 5 years? So you're not high end, you're not high street, you're kind of in that middle. Is that the income though that's going to be squeezed the most?
Well, we like that white space. Actually, we think that we offer extreme value for our creativity of our product. Our brand is a very joyous brand. It's full of color. It's quite unique, we believe. So there's always room for a shoe and a handbag as long as it's wonderful. Actually, in America, our business is almost 80% handbags. So we're not a shoe business now at all, frankly. That's where we came from. I joined in '96, so I've been here many years. The sales were a tenth of the size. The profits were non-existent. Next year will be 50 million in EBITDA. So the company's changed a lot in 20 years.
Neil, is that also because of COVID, so that people dress less in stilettos and more in athleisure and wear more trainers, that you're basically selling more handbags?
Well, for example, our biggest category now is handbags of the business, and then boots, and then sneakers, be it the heels are treble of last year. So people are going out more, of course. Through COVID, it was very difficult. The UK had a difficult time in COVID. So, yes,
So, Neil, as we talk about inflation and we talk about also concerns about supply chains, so some of the things need to be produced more quickly. It takes a long time to ship them. Like, out of your, the operational things that you have to deal with, what's your biggest concern?
I suppose looking after our factories, looking after our supply chain. And we were helping our suppliers, paying earlier than we needed to do, just to ensure we had the right supply, we delivered on time. So yes, I suppose it's looking after our relationships with our factories. That would be probably the number one point. And our distribution, our 4 partners we have in America.
Neil, thank you so much for joining us. Neil Clifford there, the Chief Executive of Kurt Geiger. Now, coming up, you've just heard The View from British High Street. We'll keep you up to date with the turmoil at the top of the British government. That's coming up shortly, and this is Bloomberg.
COVID has changed everything. People are changing the way they work and the way they travel. Can you explain what you mean?
I think the world is never going back to the way it was fully before the pandemic. And one of the changes, I think, David, has been a change in how we work. Many people had a job at an office. They're not going to be required to come back to the office 5 days a week. And I don't think CEOs per se are going to determine these policies. I think workers will, because all of us CEOs, I think, want the best talent. And I think flexibility is going to be the second most important benefit after compensation. All of this, David, has culminated in Airbnb not just being a company about traveling, but now a company about living. So there's this whole new category of travel that's not classic 2-3 nights in a city. It's not long-term housing, and it's completely emerged because of the pandemic.
A lot what's happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights
We think that's the next secular shift.
from businesses most influential and instrumental.
It's knocking it out of the ballpark.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
The Leader of the House suggests that we should be grateful that the Prime Minister has made a difficult decision. I presume she means grateful that she stuck to it, given the number of U-turns that we've seen over the last couple of days. But that's the job, making difficult decisions. There are difficult decisions to be made about what is happening in Ukraine, about the fact that President Putin has nuclear weapons, about the chaos caused by Brexit, gang crime, the climate crisis, Ebola in Africa. And all we know right now is, unless she tells us otherwise, that the Prime Minister is cowering under her desk and asking for it all to go away. Isn't it about time she did and let somebody else who can make decisions in the British national interest get in charge instead?
Well, the Prime Minister is not under a desk, as the Honourable Lady. I can assure the House. I can assure the House that she is, with regret, she is not here for a very good reason. But neither has she taken this decision to win the Honourable Lady's gratitude. She's done it out of a sense of duty because she knows what's in the national interest.
Leader of the House of Commons there, Penny Mordaunt, defending the UK Prime Minister's absence during questions in Parliament over the decision to appoint a new Chancellor. Now, let's get straight to your Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Credit Suisse is considering a sale of its U.S. asset management business. That is as the firm nears a strategy revamp that's likely to reshape its business and top ranks. According to sources familiar with the matters, the Swiss bank recently began the process to sell U.S. operations. We are told the division is likely to attract interest from private equity firms. No comment yet from Credit Suisse. Britain's reversal on its controversial tax-cutting plans are a step in the right direction. That's according to Anna Botein, the chair of one of the UK's biggest lenders, Santander.
We're a big investor in the UK. I have high confidence in the strong institutions of the country. It's a very attractive place to do business, attracts talent from all over the world. So I think, the steps taken are in the right direction.
And that's your Bloomberg Business Flash, Francine.
Leanne, thank you so much. Well, Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller, Kaylee Lyons in New York, and Edwards here in London. And this is Bloomberg.
price of anything goes up, the consequences reach far beyond what you'd expect. But perhaps most of all, when it comes to food. In 2010, surging food prices helped spark the Arab Spring. Lives were lost, regimes fell, and the consequences are still with us. Once again, food prices are rising, and fast. Energy costs, broken supply chains, and surging demand were just some of the factors that have driven food prices to their first record high since the Arab Spring. And that's all before a war between two of the world's biggest food producers. Ukraine is called the breadbasket of Europe, and taken with Russia, the two account for about a quarter of global wheat trade. They produce more than half of the world's sunflower seeds and oil, nearly 20% of the barley. Now throw in rising energy prices, and processing, transporting, even refrigerating food gets more expensive. Plus, fertilizer production is extremely energy intensive. Less fertilizer means lower crop yield, and prices rise even more. The pandemic revealed how complicated and fragile global trade systems are. Global agriculture, perhaps even more so. Unlike metals, for example, food goes bad. And crops take months to grow and are vulnerable to unpredictabilities like the weather. Rising food prices will be felt everywhere, but the poorest countries in the world will be hit the hardest. And as all these factors compound, the real fear is that record high will lead to record high, and ultimately to a global food crisis with vast consequence.
Part of what I love about business is you get to build things from nothing.
I don't have any investors. This is all money in. This is me just building it.
It's pretty much full-service shadow banking with nobody in charge.
People understand that if you're a longer-term investor, eventually the tide will turn.
This cycle is being defined not by its severity, but by its duration.
I get it that we're probably not at the bottom, and there's more stress to come, but things are starting to look pretty reasonable if you can take a longer time horizon.
Higher global interest rates, lower equity prices, and a stronger dollar, we think will continue into year-end.
We're going back to a normalization of rates, and this is actually how the system should work.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kayleigh Lyons.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. Wall Street's most vocal bull trims risk. Stocks extend a rebound, though. J.P. Morgan's Marco Kalanovich grows cautious, but Bank of America says its fund manager survey screams capitulation. Crisis management. Liz Truss apologizes for the chaos caused by her mini-budget, but suggests she won't step down. And to sell or not to sell, Credit Suisse is considering a sale of its U.S. asset management business and may get interest from private equity firms. Meanwhile, Goldman is set to report results today ahead of its own reorganization. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller in New York. Kayleigh Lyons is off today. And Matt, fascinating rebound in markets yesterday and today. The Bank of America Fund Manager Survey now says it finds full screaming capitulation. We seem to be trading like that in the short term, whether it lasts, though.
Yeah, I mean, I think they also say that a lot of the morsels they found in this survey mean the market is ripe for a bear market rally. So not that we've necessarily found a bottom completely, because there's still policy capitulation to come, according to Michael Hartnett, but there are reasons to think that the market could continue to rally in the short term. We have had gains across Asia. Most of this is due to really the UK getting its house in order. That's helped U.S. stocks yesterday and Asian stocks overnight. And I think markets seem to have shrugged off the fact that China delayed some GDP data. So overlooking that for now, the Asia Pacific is up 1.25%. The Hang Seng is up 1.8%. And then in Australia, I just noticed not only a big rally in stocks, but also in bonds, and that pushes the 10-year yield down under to 3 919. Take a look what's going on in U.S. equities, index futures, I should say, after the big rally that we had yesterday, and we closed up very positive, more than 2% on the S&P. Now we're up 1% on futures this morning, and you have investors selling debt, the yield floating up over 4%, and I think you now go up above 4% all along the curve, even out to 40 years. NYMEX crude coming down 76 cents a barrel to 84.77. So that's another tailwind there for equities today. And Bitcoin continues to stay at this range, basically unchanged, no volatility in the cryptocurrency at 19,512. What do you see in Europe?
Yeah, well, what we see in Europe then, Matt, is a continuation of this strength we saw on Wall Street yesterday, 3% higher on the NASDAQ. Well, now we're higher here in Europe again, because we were higher yesterday also. So some strength coming through, the DAX up by 1.1%. We've just got an interesting data point to add into the mix, German October ZEW investor expectations. So this is around just what investors are feeling about the future, minus 59.2. The estimate was for a more negative reading than that, of minus 66. So at the margin, perhaps that also a positive sign that things not looking as bad from an investor expectation perspective. Just highlighting some of the strength coming through, 1.4% higher on the FTSE MIB in Italy. And Telecom Italia, part of that story, there's been talk in the newspapers over in Italy about whether a bid might come through from private equity, for example, and that has pushed that particular share price around, although, as you can see, from its size, it doesn't take much to push that around these days. Let's have a look at some UK assets in the middle here then. We've got 30-year yields at 4.44%, and things looking a little bit calmer. We are seeing selling of UK long-end debt today, but the movement isn't very large. The selling isn't extensive, and the movement in yields is not very large. And in fact, it's in good company. We're seeing those yields going up more in Germany, in Italy, and other parts of Europe. So it isn't a UK-specific story today. Here's the pound, 112.98. It was up in the early part of the trading day because we had a report in other media in the UK, the FT reporting that they thought that QT was going to be delayed. The Bank of England has just put out a statement, though, to say that that reporting is not accurate, and actually there is nothing to see here, essentially. My words, not theirs. 113.12 is where we trade, though, on the pound, and the pound now down by 0.4%. Let's stick with UK themes, though, Matt. The UK Prime Minister Liz Truss apologised for the chaos caused by her mini-budget, but said she plans to lead the Tories into the next election. She spoke on BBC yesterday.
Now, I recognise we have made mistakes. I'm sorry for those mistakes, but I've fixed the mistakes. I've appointed a new Chancellor. We have restored economic stability and fiscal discipline. And what I now want to do is go on and deliver for the public. We were elected on the 2019 manifesto. I'm determined to deliver on that.
UK Prime Minister speaking there, saying she's fixed the mistakes. Of course, some in the market point to the risk premium attached to UK assets still and continue to ask those questions. We're joined now by Bloomberg's Lizzie Burden, who's with us from Westminster. So, Lizzie, has the new Chancellor, Jeremy Hunt, done enough to stabilise the economic situation, to shore up the Prime Minister's position?
Well, he does seem to have reassured many in her party. It's hard to understate the scale of this reversal from Jeremy Hunt yesterday. He's managed to plug £32 billion of the £70 billion gap in the fiscal in the finances. He has removed some of the stimulus, which means that the Treasury and the Bank of England don't need to be in such a tug of war. And of course, the Bank of England, as you say, saying that the FT was wrong to report that it's planning to delay quantitative tightening. But on the other hand, without the sugar rush, the recession risks are heightened. And no matter what Hunt did, he couldn't take away the moron risk premium, as T.S. Lombard puts it. The higher borrowing costs brought about because of the damage to the UK's economic credibility that Truss has already managed to inflict. So one guest on Bloomberg TV yesterday defined Huntonomics as Sunakonomics on steroids. He's going to have to be more fiscally disciplined, introduce spending cuts, but it's difficult politically because Labour has already dubbed it austerity 2.0.
A moron risk premium. I just want to be sure that I heard you correctly. That was the phrase, a moron risk premium. The Prime Minister seems to be hanging by a thread here. Clearly, I think there's one live stream that's looking to see if she can outlast a head of cabbage. Are there any realistic contenders to replace her, though?
Matt, I believe it's a lettuce, and that lettuce was moved under a desk yesterday because Penny Mordaunt had to confirm that Liz Truss was not in fact hiding under a desk yesterday when she was absent from the Commons, and Mordaunt was sent into bat instead of Truss in response to an urgent question from the leader of the opposition. Yesterday it seemed like Truss's cabinet was auditioning for the top job. You had Mordaunt, then you had Jeremy Hunt's various outings throughout the day. We didn't see Rishi Sunak. He's been conspicuously absent for the past few weeks, perhaps trying not to get that backstabber tag that he had last time during Boris Johnson's downfall. But whoever MPs would unite behind to anoint as leader, they would face the challenge of a diluted mandate, the need to go to the public for a general election, and no Tory wants that. Now the Labour Party has a 25-year record poll lead, so it's not a place that most in the party want to go.
All right, Lizzie, thanks very much. Bloomberg's Lizzie Burden there reporting on the current state of the UK in terms of economics and politics. Let's get back to markets. JP Morgan and Goldman Sachs offer words of caution to investors. Goldman prefers Chinese stocks over their U.S. peers. The bank says investors should sell S&P 500 calls and fund with those proceeds the purchase of the same options on the Hang Seng. Bloomberg Markets editor Valerie Teitel joins us for more. Valerie?
Thanks, Matt. And again, on that Goldman note, not only are they bearish on U.S. stocks, but they're willing to sell S&P upside to fund China H-share calls. As we know, China stocks have been a dismal performer this year. Since COVID, they're down nearly 50%. That aligns with the S&P's move of nearly 14% since the start of COVID. But look, it's not just Goldman trimming their bullish equity views. You also have the famed bull over at JP Morgan, Kolonovich, trimming his allocation into equities. But I'll leave you two with this. In the Bank of America Fund Manager Survey, it showed a 6.2 allocation into cash. That is a 20-year high, Anna and Matt. That's a huge number. Also, nearly 50% of the respondents said they're underweight equities. Now, you could argue that this means we're ripe for a risk asset bounce. I think the question now is that into the end of this year, or are we looking at the first half of 2023?
Yeah, they talk about the latter, don't they? We'll see whether this turns out to be sustained, this bounce we're seeing now then, Valerie, or a bear market hug then. Bloomberg's Valerie Teitel, thank you very much. And you can see Valerie's charts and all of the terminal analysis via GTV Go on the Bloomberg terminal. Matt?
All right, in banking news, Credit Suisse is considering a sale of its U.S. asset management business. This comes as the firm nears a strategy revamp that's likely to reshape the entire operation and those who run it. Shonali Basak, our global finance correspondent, joins us now for the details. So we continue to follow the Credit Suisse saga, and now they've got assets on the block.
They sure do. They have the asset management business in the United States as one of those parts. They have the investment bank that they are scouting interest across the globe. As we've reported, funds tied to Abu Dhabi and Saudi Arabia are among those considering an investment in any sort of investment bank deal. And of course, that investment bank CEO, Christian Meissner, is exiting. We have reported that that would happen. Now we know that it will be announced at the investor update on October 27th. The question is, how much can they give investors an update of all these other deals that hopefully will stave off a dilutive capital raise?
And Shonali, what about the Goldman's earnings? We expect numbers shortly, and we've had no shortage of things to talk about when it comes to Goldman and the structure of their business.
Is it interesting, Shonali, do you find that the British talk about investment banks in terms of like, I don't know, plural or possessive, Goldman's, Morgan's?
I was wondering where you were going to go with this. Anyways, speaking of reorganizations, in addition to Goldman's earnings, where I've got to say the expectations are quite low, Anna. The expectation is a return on equity of 10%. That would be less than what Morgan Stanley had printed. And in addition to that, it's that big reorganization that has been reported throughout yesterday that investors will want clarity to. Is this merely a reorganization? Is it a realigning of deputies, or is it a full-scale change in the way that Goldman sees some of their more moonshot projects that they have been working on the last several years? Of course, they've been punching above their weight when it comes to their core businesses, markets and advisory, investment banking. But what of the consumer bank, and what of the wealth manager, as the whole market is really looking at wealth management to really be the ballast to a lot of these businesses that are facing a lot of pressure.
Okay, whatever we call it, the focus on the numbers and the restructuring. Shanali, thanks so much. Bloomberg's Shanali Basak. And we'll have more on the bank earnings story, of course, later this hour. Timothy Morgan joins us, KBW US Financials Specialist. Great to get his perspective. Also coming up on the program, Simon French, Chief Economist at Panmure Gordon. It seems that we are seeing markets rethink quantitative tightening and tighter policy, and that's having an impact on UK assets this morning. So we'll come back to that theme, plus the rise and fall of the COVID billionaires. From Zoom to Moderna, some pandemic fortunes are beginning to crumble as fast as they soared. Read more of today's big take story online or on the Bloomberg terminal. This is Bloomberg.
When I started, I had no idea it was going to turn into this, which is a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it, building it, building it. You gotta think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual. I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles to become Chief Future Officer, like Marriott's Leni Oberg.
One of the most important things is looking around the corner.
Adrian Mitchell from Macy's.
We have to let go of the traditional legacy department store.
And Luca Zaramella at Mondelez.
We tend to believe that all consumers are equal. They are not.
Look for Chief Future Officer on Bloomberg. Tomorrow, St. Louis Fed President James Bullard sits down for an exclusive interview with Bloomberg's Kathleen Hayes. Will he offer any hint of an ease in the coming months? Find out tomorrow on Bloomberg Television and Radio.
Welcome back to Bloomberg Surveillance, the early edition. We are simulcast on both radio and television. I will point out that I'm looking at a chart right here. Those of you listening on radio clearly can't see it, but I recommend checking it out when you get the chance. You can just type GTV Go for all of the charts that we use on this program. And this one is a great picture of the incredible chaos that we've seen in the gilt market, with yields rising all the way up past 5% and then dropping well below 4%. Right now we're at 442, but the question is, what will the UK government do next? As we were just talking about, there's a bit of a moron risk premium there. Joining us now is Priscilla Azevedo Rocha, Bloomberg credit reporter, to talk about how this has affected markets. And it isn't even just local, right? The UK gilt market, or the chaos in it, has really spread around the world to roil all, well, certainly equity markets around the world. Priscilla.
Yeah, that's right, Matt. We've seen like some moments of stability coming through this week, and after the new chancellor announced the reversal of the government's fiscal policies, sentiment was improving, but the bigger backdrop still remained very, very much negative. And now, with the news that the Bank of England will not pursue with the quantitative tightening, we'll need to see how markets will react to that, and we're in for more volatility.
Okay, yes, and we've seen markets reacting a little. We saw a bit of reaction in bond markets, didn't we? But now I should say yields, yes, they're rising across the UK curve, but not even as much as Spanish, Italian, and French yields. So they're sort of in good company, more in lockstep with the rest of Europe today, which makes a change. But we have seen the FTSE 250 raising its gains as a result of those BOE comments. On another more stock-specific or company-specific front, what's the credit angle on Credit Suisse at the moment, Priscilla? Because that seems to be something that we're following very closely.
Yeah, that's right. So we're all watching the CDS for Credit Suisse to see how this is going to react because, of course, stocks have fallen. They're continuing to fall. There's still a lot of uncertainty in the air on who's going to bid for the bank and what are the next steps. We're still, of course, a few weeks from the official announcement, but we're watching what are going to be the next steps and what are the main bond holders and the credit holders of the bank reacting to this.
In terms of Europe, how much volatility do you see there from what we see in the UK? I mean, interestingly enough, it doesn't seem like the ECB or European policymakers have made as many missteps.
Yes, that's right. There's some volatility in Europe, but things seem to be more contained when compared to the UK. People, of course, they're watching Italy, they're watching other bond markets to see how they're going to react to the news now coming from the UK. But there is fear of contagion, especially in governments like Italy, Spain, France.
Yeah, absolutely. Fear of contagion, fear into countries, in particular ones that have ongoing concerns around debt. Some slightly brighter news, and I've talked about this in recent days, the rate at which we're seeing gas prices come down, Priscilla, is this something we maybe need to keep in focus? 117 euros per megawatt hour means probably nothing to anybody, but it is a lot less than 350, which is where we got to at the height of this crisis. This is something, as the weather continues to be not too cold here in Europe right now, this is something to watch.
Yes, this is absolutely something to watch because governments now, they have been focusing on storage, on gas storage ahead of winter, on raising money to source gas. There's a lot of news this morning from Enel in the market looking to raise a credit facility for energy. ENBW is also looking at private debt markets. There's a lot of concern on how they're going to fund and how they're going to raise money throughout winter. With gas prices a little bit lower, this of course, gives them some room to breathe.
Okay, Priscilla, thank you very much. Thanks for joining us. Bloomberg's Priscilla Azevedo-Rocha with the latest on the markets. You can get further market analysis. Check out MLIV Go on your Bloomberg terminal. This is Bloomberg.
If you do any kind of business in this country, there's a pretty good chance that you're going to see that business registered in Delaware. Why? Because that's where you do it. And our point was Wyoming can be that venue for blockchain enterprise, for crypto.
It's not the Wyoming way to sit around and wait for change. We want that independence, we want that freedom, we want that individuality. And that's a common theme that brings together bipartisan support for this in Wyoming.
We want to make sure that people understand, especially in Wyoming, but as the United States as a whole, this trend is coming. It's not going to stop. This is more of a small town that's growing into what I would call the cryptocurrency version of Silicon Valley.
It's the philosophy of that rugged individualism, the independence, and the ability to really get things done for yourself and control your own destiny. You get that from a blockchain, and you don't get that without it.
From the world of politics to the world of business. Balance of Power with David Weston. News, analysis, insight from and about politics power players. Weekdays. This is Bloomberg.
Hello, I'm Emma Barnett, and I'm a journalist and presenter. This is my new show, Emma Barnett Meets. First, I'll be meeting Chinese artist and dissident Ai Weiwei, and I'll talk to the novelist and political scientist Elif Shafak. Tune in to watch those who shape our world explain how the world shapes us. This is Emma Barnett Meets on Bloomberg Quick Take.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller in New York with Anna Edwards in London. Kaylee Lines is off today. Now, keeping you up to date with news from around the world, here's the first word. Slogans attacking President Xi Jinping featured on banners on a Beijing bridge last week have spread to other cities in China as well as across the globe. Phrases from the original handwritten banners have criticized strict lockdowns and restrictions that have defined Xi's COVID-0 policy and called for new elections. German Chancellor Olaf Scholz has ordered an extension of the lives of the country's 3 remaining nuclear plants until April 2023. The decision is meant to end a standoff between 2 coalition partners. The Greens are opposed to nuclear power, but the Free Democrats argue Germany should use all the generation capacity available to tackle the energy crisis. And President Biden's political travel schedule is lighter than his immediate predecessors. At the same point in the midterm campaign, it's a challenge unpopular presidents face in trying to stave off congressional losses. During the same week in their first midterm campaigns in 2018 and 2010, former presidents Trump and Obama traveled to 3 and 4 states, respectively, for political events. Chip delivery times shrank by 4 days in September, the biggest drop in years. It's a sign that the industry's supply crunch is easing. Lead times, which is the gap between when a chip is ordered and when it's actually delivered, averaged 26.3 weeks in the period, according to Susquehanna Financial Group, down from nearly 27 weeks in the prior month. And, you know, the one thing that I think is a little bit confusing, Anna, in terms of the chip story is that certain industries are still finding it very difficult to get chips, or more difficult than usual. For example, the automotive industry is not getting enough chips to produce all of the cars that they could sell. Still, at the same time, PC companies are swimming in chips, and no one is buying too many PCs for the chip supply. So chip makers that produce those kind of chips are having to report losses in profit, as the chip makers that report or produce automotive chips are having to ramp up capacity.
Yeah, as we talked about in earnings season after earnings season, it seems, since the height of the COVID pandemic, Matt, not all these chips are created equal. They don't all go to the same end use, obviously, and different chips have different lead times, it would appear. What is interesting about the story, though, and it also makes the point that the lead time is coming down, the waiting time is coming down, but of course, this is a sector now facing other challenges. Geopolitics very much in the mix here, as we've seen President Biden taking measures to restrict the ability of U.S. producers to export to China, for example.
Yeah, absolutely. And it still has to be seen how that's going to play out, because it doesn't seem like businesses are shying away at all from getting equipment or technology produced in China or Taiwan.
Yeah, coming up on the program, Simon French joins us, chief economist at Panmure Gordon. We will get his take on what the latest volatility in gilt markets has meant for the trajectory of QT. We'll get into that conversation. This is Bloomberg.
today, what are the biggest challenges for General Dynamics and what are the biggest opportunities?
So I think in any business, the challenges are solving complex problems that come to you. You know, they're the problems that come to me and my senior leadership team for resolving tend to be highly complex and nettlesome. So your ability to solve those complex problems are an important element, I think, of the value that we add to the company. And then I think opportunities, you always want to make sure that you've got a creative enough mind, an open enough mind to be able to see around square corners. What am I missing? You know, the why questions are really powerful. Why are we not doing this, or why are we doing this? I ask those questions a lot, and in the answers, you can sometimes tease out some real opportunities, some hidden things. But thinking creatively about opportunities and problems is really important.
And what about the industry generally? Do you think they have big challenges now as the defense budget probably comes down a bit?
So I think that we are all responsible, and we have an obligation to find the latest and best technologies that we can for our customers and deliver them in the most cost-effective manner we can. And I think that that's a challenge and an opportunity for all of the big defense companies.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Wall Street's most vocal bull trims risk. Stocks extend, though, a rebound as JP Morgan's Marko Kolanovic grows cautious. But Bank of America says its fund manager survey screams capitulation. Crisis management. Liz Truss apologizes for the chaos caused by her mini-budget, but suggested she won't step down. And to sell or not to sell, Credit Suisse is considering a sale of its U.S. asset management business and may get interest from private equity firms. Meanwhile, Goldman is set to report results today ahead of its own reorganization. I'm Anna Edwards in London with Matt Miller in New York. Kaylee Lyons is off today, and we seem to see some real exuberance, maybe a temporary bear market rally, who knows, Bap, in stocks, but something has got markets excited yesterday and today, a bit of a turnaround from the negativity of Friday. But maybe some of that exuberance just waning in the wake of some of those lines from the Bank of England half an hour ago. Yeah, although it's not irrational. It doesn't seem irrational, right? If you look at the Bank of America survey, screaming capitulation, 6.3% cash. That's the most that investors have held since April of 2001. Actually, so as Valerie pointed out, it's been 20 years since we've seen those kind of cash levels. The S&P 500, S&P futures, I should say, the E-mini contract right now up more than 1% after the S&P 500, the cash trade closed yesterday over 2% gain. Investors are feeling comfortable enough to sell off debt. The 10-year yield is up over 4% right now, 4.0231%, and I double-checked. Across the curve, from 2s to 30s, you're getting more than 4% returns on the U.S. 10-year. This is actually one of the headwinds in a sense now. Okay, investors feel comfortable enough to let go of the debt, but as this yield gets even higher, it poses a challenge, a little bit of competition to stocks. Investors always comparing stocks and bonds, of course. NYMEX crude off 48 cents right now a barrel to 84.98, so coming down a little bit, maybe not panic levels, so we're not worried about the bottom falling out of demand, certainly not here in the U.S., and we do still have really elevated fuel prices relative to what we have previously, not relative to what you have. I filled up this morning for over $5 a gallon. Bitcoin right now at $19,554, so holding incredibly steady, absolutely no volatility in the OG cryptocurrency as there is in pretty much every other asset class, which is like opposite world in a sense. Anna, what are you seeing in Europe? Yeah, it is certainly not what maybe we'd expected, not what we saw at the beginning of the tightening cycle from the Fed either. Let's have a look at what we've got in Europe then, Matt. I've got a deep dive into UK assets, but here, starting with the pan-European picture, up by 0.4% on the stocks 600. Have we seen then capitulation, as you've referenced, that Bank of America investor survey? Interesting. We'll talk about that in a moment. Here's what we've got on the UK front, though, and interesting to see that earlier on today, we saw a rally in the pound. It's currently at 113.41 and a little bit weaker. We saw a rally in the pound on that FT report that suggested that the Bank of England might be about to delay some of its quantitative tightening. We heard from them yesterday they were going to be selling corporate debt, but what were they going to do with the government gilts that they'd planned to sell? There was this report that suggested they'd delay that. The Bank of England has come out and said that report is not accurate, and so the pound has lost a bit of ground, 113.11, as I say. Interesting that the UK 30-year yield has sort of fallen in with the mix of European government debt markets today, and that's no bad thing, and that's more than can be said for the past couple of weeks, so that's interesting. 4.45 is the yield on the 30-year right now. And the FTSE 250, I put this in because we did see a real strength to the FTSE 250, but as we got that comment from the Bank of England that no, QT is not going to be delayed, that there wasn't accuracy in that report, that then we saw the FTSE 250 coming off those recent highs. So it was up by more than 1% earlier on today, and it lost some ground as a result of that report, Matt.
Yeah, it looks like there could be a little bit of a contrarian indicator there. Because the Bank of England is sticking to its plans, or at least that's what it says, and that's what it did last week as well. The UK's reversal on tax cutting plans probably helping them to do that. Positive for investment as well, as you can see really from the rally in stocks around the world after that kicked off over the weekend. Also, according to Banco Santander Executive Chair Anna Botín, she spoke exclusively with Bloomberg's David Weston.
We're a big investor in the UK. I have high confidence in the strong institutions of the country. It's a very attractive place to do business, attracts talent from all over the world. So I think, the steps taken are in the right direction.
Let's get over to Simon French right now, chief economist at Panmure Gordon. Simon, what do you think of the U-turn that we've seen and how much more needs to be done in the UK?
Well, I'd agree with Anna Botín that there is a positive sentiment around in the last 24, 48 hours as a result of this U-turn from the government. I mean, a lot of investors will be perhaps looking on at the UK, particularly international investors, and going, okay, so tax cuts have been reversed. How is it a more attractive environment for business investment? But the reality is the business investment it craves a stable macroeconomic framework. I'm afraid, and against the environment of 4 chancellors in 4 months, it was quite difficult to argue that the UK, for all the strength of its institutions, has a stable macroeconomic framework. There have been signs in the last 48 hours that that journey back towards credibility and stability have begun, but it's going to be a long road.
A long road. Credibility quickly lost and takes a long time to rebuild is the way that, many describe it to us. As the markets have flexed their muscles around this then, Simon, what kind of broader messages do we take away about the ability of governments to stimulate with fiscal policy when times get tough, if they do, in forthcoming recessions?
I think the lesson we take away from this is that you have to prime the market in terms of what your plans are. I think that was a failing of the UK government over the course of the summer. But you also need to read the macroeconomic room. And if we look at the macroeconomic mix that the government is trying to pursue, loose fiscal, tight monetary policy, you could very well argue that global events, I would argue that global events, the war in Ukraine and the impact in energy markets leading to significant fiscal bailouts, plus the tightening led by the Federal Reserve having to lean into a demand surge in the United States, was doing that fiscal pivot anyway. That's what I mean by reading the room. Experienced economists in the UK have said all summer to the government, this pivot is taking place anyway. It's a very noble argument for a different macro mix to the one we've seen in the last decade or so. But if it's happening already, is the market going to think that you're adding fuel to a fire that is already burning? And I think that was the interpretation, and the interpretation that other governments around the world should take from this.
And do we focus then on other places with relatively high debt levels? Do we focus on southern European countries, or specifically Italy, perhaps, and think about fiscal policy? Because actually the new government there has been at pains to talk about fiscal discipline.
Yes, although There is there is an obsession to look at debt to GDP ratios as if you like instructive of how much headroom there is. But I think that sits in a sort of second order level of indicators. Institutional credibility, the messaging, the being able to present the fact that additional, like any CFO of a PLC around the world, if you're going to make an argument to go back to debt markets to ask for more debt, you need to credibly make the case, and if that is credibly made the case to your lenders, then they will forward you additional credit lines. In that respect, government credibility, the plans, perhaps trump the underlying metrics we may be used to in terms of net debt to EBITDA, or in the government's case, debt to GDP.
Let me just get away from the UK and the West, really, as we continue to watch Xi Jinping and this party meeting here. GDP figures were delayed. It doesn't seem to have bothered the markets one bit, and we had an interesting call out this morning from Goldman's saying that investors should sell calls on the S&P 500 and use the proceeds to buy the same in Hong Kong. What do you think of the Chinese economy right now as we continue to see lockdowns and concerns about them?
Well, I think as an economy that has contributed about 40% of global GDP growth over the course of the last 15 years, there is a very clear slowdown both underway, but also now sort of structurally being added to by some pretty hawkish approaches to trade from the US. Now, part of that will be the understandable rhetoric and indeed actions sought ahead of the midterms. It politically will poll well. But I think you are starting to see now quite deeply held concerns that the impact of a slowdown in China makes some of the parts, earnings parts of S&P indicators, global equity indices around the world, not really believable in terms of their 2013 numbers, and therefore we're entering a downgrade cycle. The debate amongst equity strategists is how significant that downgrade cycle is. And you mentioned at the very top of this segment the rising bond yields. That spread now between the risk-free rate and the potential earnings yield on the S&P makes that equity risk premium look very low by historical standards. And I think it's not unrealistic to see a further drawdown of maybe 20 to 25% to try and re-establish those historical norms of the equity risk premium.
Simon, thank you very much. Thanks for joining us. Good to get your perspective today. Simon French of Panmure Gordon. Coming up on the programme, we'll get back to the bank earnings story. Timothy Morgan joins us, KBW US financial specialist. What are the messages he's taken away so far from the bank earnings season? And we'll look ahead to the numbers from Goldman Sachs. This is Bloomberg.
What do you think of when you think of a battery? For most, it's what we use to power devices for both work and play, and maybe even your car. Over the past few decades, they've gotten way more powerful, long-lasting, and affordable. But all of this is just a prologue to what the next batteries are going to do.
As we drive to an increasingly renewable power-driven grid, we also need to be able to store energy and release it later to cover those periods of weather intermittencies that are driving this new grid that we're in. It's a multi-trillion-dollar opportunity, and it's imperative that we figure out the solution here.
How we store energy on a massive scale is in many ways the central challenge of the fight to stop climate change.
The
difference between endless research and a winning strategy. To improve your firm's productivity and profitability, Bloomberg Law combines the latest in AI-powered tools and in-depth analysis to accelerate the research process. To grow your practice and make better use of your valuable time. The difference is Bloomberg Law.
Their credit quality and the credit quality of Bank of America in our consumer books is very strong across the board. The payment delinquencies are much lower than they were pre-pandemic, much lower than they were in any average 5 best year type period. And yes, they moved a little bit off the floor, but they're still much lower than they've been. So consumers are spending, they have money, they're employed, you can see the unemployment numbers, and they have good credit.
Brian Moynihan there, the CEO of Bank of America, speaking with Bloomberg yesterday after the bank reported third-quarter results that beat expectations. Let's talk about the sector. Timothy Morgan, US financial specialist at KBW, joins us now here in London. Tim, really nice to speak to you. Let's start with the point there we heard being made by Moynihan about delinquencies. Yes, they're up, but they are less than they were pre-pandemic. This is still a journey back to where we started, I suppose, back through all of the unwinding of the large savings pool that people built up during the pandemic. What did you take away from that consumer story?
Thanks, Anna, and thanks for having us on today. The bottom line is really simple. We still are at essentially very far from recessionary type numbers. We've seen some very small increases in credit problems from the subprime customer group in the U.S., but by and large, the banks are out of that business and are focused on prime and commercial customers, and there's just been no sign of it yet. So as Brian said on his conference call, I mean, there are some signs of credit deterioration, but for starters, they're tiny. And secondly, most of what the banks are seeing right now, they would just call normalization after, as you said, an amazing period of credit stability through COVID.
We've seen an uptick, I should say, in credit card usage, I think, 13%. I don't know how much of that is down to inflation, but it always concerns me when consumers are putting more purchases on credit. Is that concern misplaced?
That's a good question, Matt. I mean, historically, when consumer credit gets hot in the U.S., it can be a sign of the end of a strong cycle. But you have to remember that consumer credit fell off of a cliff in COVID. We actually went to 0% growth in credit card usage for a period. And actually, the recovery that we've seen in credit card growth is simply on track to take us back to the spending levels that we would have expected if you extrapolated from 2019 to the end of this year, growing at about 4%. So yeah, the numbers have been eye-popping currently, but I think we could still call it mostly a catch-up effect.
We also heard, I guess to the positive side for consumers, or at least bank account holders, that their accounts were still excessive compared to what they were pre-pandemic, in a good way, not excessive in a bad way, obviously. Is that representative, you think, of the average American, or are the people with deposits at Bank of America at a higher income level?
That's a good question, Matt. And honestly, I don't have a strong answer to that. I mean, as you appreciate, we have different consumer groups, and the banks do tend to focus less on subprime now, where we know it's, paycheck to paycheck every month. I mean, we did get a good breakout of deposits by Bank of America, and they showed that we're still well ahead of the 2019 levels for practically every savings group. So that's not by income group, but by deposit savings level, sort of under $2,000, 2 to 10, and over 10.
So going into this earnings season, it seemed as if, given what was happening on net interest income, or expected to happen on net interest income with higher rates, that maybe it would be Main Street banks that would do well and Wall Street banks less so. And maybe that is true with investment banking under pressure, but some areas of FICC with trading activity have been quite resilient. So what's been the contrast for you?
Oh, well, I mean, those are the two great stories for this quarter. I mean, net interest income's up more than 20%, and we're expecting it to stay like that for a few more quarters, although with declining impact. So it's a side issue, but we do have investors wondering about whether we're at peak net interest margins and peak net interest income. FICC, of course, has benefited from all the volatility and what it stands for, fixed income, commodities, and currencies, which, of course, have been buoyed by all the other news you guys write about. In the meantime, equities and the investment banking business, on the other hand, however, have been dealing with practically shut markets.
Yes, I mean, on that theory about whether we've reached peak net interest margin, is that based on expectations of how far the Fed can push things before an economy starts to roll over, or what is that debate encompassing?
It's simply what you've just said. I mean, the Fed's expected by most people, consensus and us, to stop hiking as we get into the first quarter of next year. So the tailwind behind the banks of rising interest rates is, at least at this stage, expected to stop. And then what happens after that is what they're paying depositors starts to catch up after that. And so net interest margins start to shrink even if interest rates stay flat.
Okay, thanks so much, Tim. Really good to speak to you. Tim Morgan of KBW, joining us there to talk about the banking sector. In focus, also entertainment. Coming up, Netflix reports third quarter results after the bell today. We will preview what to expect there. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
What I love about business is you get to build things from nothing.
I don't have any investors. All this is all money in. This is me just building it.
It's pretty much full service shadow banking with nobody in charge.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. Welcome to Bloomberg Crypto.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller in New York with Anna Edwards in London. Kaylee Lines is off today. Let's get a look at what's ahead, what's coming up for the rest of the week. The European Union will release the details of a new energy intervention package today as the bloc looks to tackle an unprecedented crunch. Maria Tadeo is going to be all over that. Expected eco data includes U.S. industrial production on this side of the pond, and Minneapolis Fed President Neil Kashkari is also due to speak. There's a host of earnings to sift through. Goldman Sachs is out in just about an hour and 40 minutes. Johnson & Johnson is coming out, J&J, and Netflix as well among the companies slated to report.
Yeah, let's pick up on that one then. Here to preview the results of Netflix, Alex Webb, correspondent for Bloomberg. Quick take, always here when we want to talk things tech-related, and this sort of qualifies. Alex, what's going to be the headline? It's going to be all about subscriber growth, is it, after what happened the last time?
Well, two things. Firstly, yes, subscriber growth in the first 6 months of this year. They lost 2 million subscribers in the US. They're saying globally the market's looking for 1 million new subscribers. But there's also going to be a lot of attention on the comments to do with the ad tier. They're introducing an ad-supported tier, which will be cheaper at the point of entry, but will obviously be subsidized, therefore, by ads. Any commentary on what that will mean for their earnings will be paid close attention to.
So I think that's really fascinating because I don't know what the story is in the land of pounds and euros, but here in dollar territory, it means a $15 a month payment compared to a $7 a month payment, so less than half. And I'm wondering, Alex, is this going to be, existing subscribers like me shifting down? Will it cannibalize their, bigger spend clients, or is it bringing in new people who thought, previously 15 is too much, I'm not paying that, but I will pay 7?
So there are two pieces to it. Yes, it's about reducing churn, existing subscribers who go, I don't want to pay that, I want to go to a lower tier, but also trying to attract people who otherwise wouldn't afford it. And I don't think we need to look at the $15 tier so much as the $9 tier. There is a $9 tier, which is their basic level, where you only get to play it on one device at any time. The thing is, they could actually quite quickly end up making more money from those subscribers than they could from the $9 they currently do. Because if it's $7 and they're able to do the same as what Hulu does, which is $6.50 in ad revenue per month per subscriber, you're very quickly at $13.50, which is more than their basic level tier is right now. It also means they can tell investors there's a lot more upside. If we look at, say, Facebook, which has consistently managed to grow average revenue per user, because ultimately, as long as you've got people's attention, it's easier to attract advertisers. So it helps reinvigorate the growth story, perhaps both in terms of subscriber numbers and the revenue you get from each subscriber.
Okay, and whether it costs $15 or $7 or $9, depending on how many households are sort of jumping on that same password, it has an impact, doesn't it, on their subscribers? So what are we going to hear about cracking down on password sharing? Because this has been an issue.
Yeah, so there's something they've been trialing in, I think, Latin America, trying to ensure that people don't share their passwords as readily as they have done in the past. Anything they're able to say on how effective that has been, and actually how they're going to model this sort of thing. I think the suspicion is that it'll be, for example, if you go on holiday and you're using something from a different IP address for, say, 2 weeks, that's kind of fine. But anything after that, then they start to ask questions and crack down.
And they have the technology to sort of track whether people are using it on, quote-unquote, too many devices or in too many locations.
Yeah, I mean, you have an IP address, which clearly should let you do that. One does, some people use a VPN from their, if, say, you're in the UK, they might try to use a VPN to watch Netflix in the US to get access to different things. Be interesting to see the implications for some of that. Frankly, I think that a lot of it is playing around the edges. The more significant thing is very much the ad-supported tier.
Yeah, okay. Alex, thanks so much. Alex Webb joining us there from Bloomberg. Quick take. I'm sure all of these things closely going to be watched by Matt Miller as we head towards those Netflix numbers due after trading today.
Yeah, no, very much looking forward to it as we get really into the heart of earnings season. We had kicked off last week with the big banks, and everything looks like it's going so well. Yesterday, certainly Bank of America didn't hurt the outlook. So Goldman Sachs is going to be huge into today's earnings, but Netflix as well. I mean, these big FANG stocks, these big tech stocks really have been leading, at least yesterday led the rally. So we'll see if they can continue to pull us higher today.
And I thought your question to Tim was really interesting around just how representative is the messaging we're getting from these banks of the average consumer in the United States, because we're certainly not hearing that the consumer is in a terrible place and they're very ready, gearing up for a recession. That's certainly not the vibe we've got from the bank earnings story.
No, it sounds like the consumer is in a great place, at least when you listen to Moynihan. Their credit is good, their accounts are elevated, and they're using more credit. But on the other hand, you have people upgrading Walmart and Target because the consumer is supposed to be switching down.
Yeah, okay. Lots more to come then. That's it for Early Edition. Surveillance continues. Tom, John, and Lisa will be back with you. They'll be hearing from, amongst others, Kit Jukes at SocGen. This is Bloomberg.
So as you look back on your career, what would you say is the best investment advice you've ever received?
Probably the best investment advice that I never received, but that I've lived my whole life around, is surround yourself with really good people. I thought about it just today, like I do many times, what makes a great investor? A great investment firm is comprised of people who are optimists and pessimists and realists. Because in the intersection of the debates that go across that wide range of personalities is where you find truth. It's part of the reason I'm so focused on freedom of expression. I see it in my own four walls, the robust and fulsome debates around how we commit our capital, what defines a good idea, what businesses to build or pursue. That's what drives the success at Citadel. And I've been very fortunate in life to have always had a group of friends who really push me, who make me better. And here I get to work with 3,500 colleagues who in their ways make me better each and every day. And collectively, as a team, we've had the opportunity to have an incredible impact on the financial landscape around the world.
This cycle is being defined not by its severity, but by its duration.
Higher global interest rates, lower equity prices, and a stronger dollar, we think will continue into year-end.
I just think the stock market's washed out.
I think that 3,200 mark, if 35 doesn't hold, I think 3,200 is the next natural place to go.
I get it that we're probably not at the bottom, and there's more stress to come, but things are starting to look pretty reasonable if you can take a longer time horizon.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Farrow. Futures up and away again on the S&P 500, up by 1.29%. TK Goldman coming up a little bit later.
Yeah, Goldman coming up a little later. It's going to be interesting after the generally good news we saw. But, John, it's finally a quieter tape. Yeah, lift in equities and that. And you say, why? And I'm going to one person, B. Moynihan. And that is the comfort here. And you wonder, do we get the same surprise from a beleaguered Solomon like Moynihan? He's going to say, I'm sorry, business isn't all that bad.
Let's sit on Bank of America and talk about the other consumer banks as well, Tom. So Brian Moynihan of Bank of America coming out and saying consumers are spending. They have money, they're employed, they have good credit. That was echoed by Jamie Dimon at JP Morgan as well. Consumers are in very good shape. You had Jane Fraser over at Citi. The U.S. economy remains relatively resilient. We know all those things about the U.S. economy in the third quarter. Can you say those same things in about 6 to 9 months' time?
No, that's always a worry. And it goes to the conference calls and this dreaded forward guidance in the corporate space. Gina Martin Adams is really good at this at Bloomberg Intelligence, and she says, yes, there's a weight to looking out further now like there wasn't a year ago.
Early days in earnings season, Bramo, but are we skipping over a very low bar for the third quarter?
A lot of people say that, and we're not even skipping over that much. And when you don't skip over it, you get punished pretty badly. It's hard to come away with any kind of conclusive narrative with some of the trading activity, especially when you have Bank of America reports talking about embrace the bear, but prepare for the bull, and all of these sort of, metaphors that are what is it? How to be a more comfortable bear. Embrace the bear, but don't get kicked by the bull.
Therapy?
This is therapy for people who are looking at a rally that's going to rip their faces off because it doesn't make any sense, but it's the meantime.
Are we all vulnerable this morning?
I think so.
A little bit. I feel so vulnerable. Okay, give me some more tang. Okay,
this sounds like Southside therapy. I sat there on Friday doing Bloomberg Real Yield, and I turned around to the guests and I said, I feel like this should be just a 30-minute show of market therapy.
It's about losses.
To get through the week.
Let's just do this. The bear market down 15%, down 18. The bond market market, I'm sorry, as we open the show today, it's a quieter day. We need to look at -20, -30. I looked at one ETF bond fund down 34%. John, that's a bear market, and that's where you need therapy.
I've heard a lot about scope for a bear market rally. We heard that from Hartnett over at BFA this morning. No cuts, no glory, is what he has to say, though. Ultimately, you've got the ingredients, perhaps a recipe to get a bear market rally, but the lows for the team at BFA in that fund manager survey, not until the first half of next year.
And it's exactly because of what you just said. It's not about jumping over a low bar for this earnings season. It's about what happens next. And what's the guidance going to really give us if you have no guidance into next week? Other than, evidently, Mike Wilson, he has a crystal ball. Nobody else seems to.
He seems to have some insight nobody else has, TK. Mike Wilson over at Morgan Stanley. It's kind of unreal.
And what's great about a guy like Mike Wilson, and there's many others we talk to every day, folks, is they have a humility about it. Mike Wilson knows he's going to get it wrong at some point, and he has that earned. Would you like to speak?
Talking about earned humility. Marco, did you see him capitulate?
He trimmed. I don't know if that's capitulation in Marco's world. I'm not sure that he'd appreciate that particular phrase.
I'm just saying. I mean, he kind of walked back some of the risk appetite that he
trimmed
had.
his overweight on equities. It's still overweight.
All right, fine, fair.
When he goes underweight on stocks, then we'll make the change. We'll talk about the gilt market in the Financial Times a little bit later as well.
I feel guilty too.
Super excited about that too. Let's whip through the price action for you. On the S&P 500, we are positive by 1.3%. Elevated in the equity market on the S&P, pushing higher once again. In the FX market, look out below cable. Cable breaking lower by 0.8%, 112.70. So the FT comes out this morning, Tom, and says the Bank of England is getting ready to delay the start of QT. Then the Bank of England comes out and says that report is inaccurate.
They're making it up as they go. I thought it was as a complete amateur on this, I thought it was a difficult day for the Prime Minister yesterday. It was really her toughest.
You thought yesterday was difficult?
Of all the different days, yesterday was just difficult. The other thing I noticed in the data, and finally, folks, a fairly quiet day, is dollar-yen. I was surprised. It's a solid 149 here.
Getting closer, eh?
It's something here to watch. That's all there is to it.
Yields right now on a 10-year as well, just to round this out for you. Pretty much unchanged, up almost a basis point to just north of 4%. Bramo, some big moves in this market the last couple of days.
Yeah, how much are earnings really going to feed into that? You talked about Goldman Sachs earnings coming out at 7:30 a.m. today. The last of the big banks to come out. How much is that really indicative of what we're going to see from the rest of the earnings complex, the rest of corporate America? Netflix after the bell, United Airlines and JB Hunt, some of the other names. It really starts to kick off and broaden in terms of scope of the companies that are reporting earnings. I am particularly interested to see the post-COVID darlings that have lost their luster, like Netflix. United Air, I'm very interested in because air travel has continued to take off despite the fact that tickets are just so expensive and people still seem to buy them. Today, economic data includes U.S. industrial production out at 9:15 a.m. and NAHB housing market index data at 10 a.m. And Tom, how much is home builder sentiment deteriorating? It's expected to go to the lowest going back to 2012. How much does this really lead to what you're worried about, which is some sort of housing crisis?
Well, yeah, I don't know if it's a housing crisis. It's just going to be an adjustment, the mother of all adjustments here with mortgage rates. They're 7%.
The mother of all adjustments, a crisis, tomato, tomato. And also today, Fed Speak includes Atlanta Fed President Raphael Bostic at 2 p.m., Minneapolis Fed President Neil Kashkari at 5:30 p.m. What do they say about front loading? We have heard this, Jim Bullard talking about possibly raising rates to 4.75% by the end of this year. Is this the goal, to raise it to that kind of level and keep it there and pause there and try to get ahead of it? Or is gradual more of the theme? And I think that that's going to matter, John, in terms of the risk appetite, what people see going forward for the Fed and rates.
Hey, Lisa, thank you. Let's talk about the rate market. We can talk about QT, and let's talk about sterling. We'll do that with Kit Jukes, Chief FX Strategist at SocGen. Kit, help me out here. So when I report that QT gets delayed, sterling climbs to session highs through 114. On the pushback from the Bank of England, sterling falls to session lows. Kit, am I to believe that QT is somehow sterling negative and delaying QT is somehow sterling positive? Based on the price action, that's what it's telling me. What did you make of that?
I think the price action tells you that by the time you've had two conflicting messages within one morning, the second one coming at the start of an gilt auction, everybody's looking at the UK and say, please, 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 can you get the messaging right to us? We are all confused. Because what we need for the currency and what we need for the market is for the volatility to go away, for everything to calm down, and to put this kind of period of massive uncertainty behind us. So contradictory reports just don't help in that regard. at this point in time. I mean, the most confusing thing of all next would be that although they're not planning on delaying the start of QT, if they go on and do it anyway because of the volatility in the gilt market at some point in the next couple of weeks, and then we'll be full circle.
Kid, I thought your
maybe
note,
some people should say less.
I thought your note today was really lovely, and it was very indeterminate. It was like, we need to wait, now what? What do you do with a strong dollar reality given the unsettledness of your note? Can you go the other way and call finally weak dollar, or do you just sit here?
I wish I could, but that's why I think that what we do is we get stuck with less volatility. I mean, there are two problems with looking for a weak dollar. One is you just have to embrace the idea that we're going to have the softest of soft landings in the United States, and everything's going to be fine and lovely, and the equity bulls are right. And the difficulty with that is, if the economy doesn't slow, they'll hike more, not less. And we're going to get a very, very inverted curve by Christmas at this rate. So that's the first difficulty. And the second one, frankly, is still Russia, Ukraine, the whole problem that we have out there. That how do I turn around in Europe and say, I want to sell the dollar? Shall I buy the pound? Shall I buy the euro? When I'm getting newspaper reports about, if we have cold days in the middle of winter in January, February, the lights are all going to go out. Have we priced that in properly yet? I'm not sure. So we could get stuck here. I guess that's the end conclusion of that until we get the next trend, and the next trend might be kicked off by the next leg up in 10-year note yields.
Just quickly, Jordan Rochester was on yesterday of Nomura, and he was talking about how, central banks are important, but really it's about the economic trajectory. And right now, more of an austerity kind of approach from fiscal policymakers in the UK will lead to a deeper recession, and that means a more negative outcome for the pound. Is that the kind of rationale that you think is what you should be following? How much is the economy really the main driver here?
I think the economy becomes one once we stop focusing on the politics, because it's not as important. And the economy is heading into a recession that could last a long time. And yes, to the extent that, that there's a sort of a wisdom out there that says what you need to do when your financial position as a country, when your fiscal position's poor, is tighten fiscal policy really aggressively, and in the hope that that'll improve it, as opposed to get yourself any chance of growing out of your fiscal problems, then we start looking more like Japan every second. And so, that's pretty scary for a country like the UK with the current account deficit and for sterling. So, it's not a great picture. I think the only piece about sterling right now is, we're priced for a lot of bad news. Sterling can be held down here. I don't know how much further it can fall unless something really negative happens. What I still can't see is the policies that would let the economy do better than expected, and people start looking around and saying, hey, this thing is a cheap asset that I want to buy.
Hey, Kit, final question. Can Arsenal win the league?
No.
Just flat out no. Are you saying no because you're worried that if you say yes, it won't happen?
I'm saying no because Manchester City are the best side in that league, whatever happened at the weekend.
Kit Juice-Socchen, thank you. I've given Kit so much grief over the last 10 years or so on his support of Arsenal Football Club, and they're just refusing to engage the prospect of winning this title, Tom.
For American audience, where are we are we still early in the season?
Still early, Tom.
Okay.
They're going to go on this ridiculous 1-month break for the World Cup, which is just insane. I detest the idea of.
Yeah.
Furious about it.
And to be clear here, for those of us that don't know, there's a team like Arsenal, all the different players go play.
They've all got to go pay for their countries and then come back, and going to lose a lot of momentum. They could do anyway.
They did that in hockey with the Winter Olympics, never worked out.
Sterling negative 0.75%, 112.74. What do they do? Do ice hockey in the summer? They do that anyway, don't they?
Yeah, they do that.
That confuses the heck out of me. I just do not get that at all.
I played hockey once at Davos. It was great.
Did you?
On the rink there, right?
Did you actually?
Yeah.
In proper skates?
After the fourth martini, it was something.
Do you remember when I played skating as well and ended up on my back on a hill?
Yes, I remember that.
Good times.
The annual Pharaoh fall down.
Yeah. Don't wear brogues to the snow, okay?
Thanks.
Peter Cheer of Academy Securities joining us a little bit later from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. German Chancellor Olaf Scholz has ordered an extension of the lives of the country's 3 remaining nuclear plants until April 2023. The decision is meant to end a standoff between 2 coalition partners. The Greens are opposed to nuclear power, but the Free Democrats argue Germany should use all the generation capacity available to tackle the energy crisis. Slogans attacking President Xi Jinping, featured on banners on a Beijing bridge last week, have spread to other cities in China as well as across the globe. Now, phrases from the original handwritten banners have criticized strict lockdowns and restrictions that have defined Xi's COVID-19 zero policy and called for new elections. And Chinese junk dollar bonds have dropped to a record low as a property crisis is showing signs of improving. The notes are dominated by real estate firms, and the average price fell below 56 cents. It's hit that level before, in August, before government support fueled a rally. The Biden administration moving forward, releasing at least another 10 to 15 million barrels of oil from the nation's emergency stockpile. The move is said to be meant to balance markets and keep gas prices from climbing even further. The Strategic Petroleum Reserve release would be the latest in a 180 million barrel program that began in the spring. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
What do Formula One cars and your local supermarket have in common? Well, strange as it sounds, they might both be using the same technology. A lot of innovation has trickled down from the world of high-tech engines, and it hasn't just found a new life in road cars. F1 cars have long been thought of as the peak of cool, and technology in them is also helping to cool down our produce aisles. Engineers from Williams are using their knowledge from 9 Constructors' Championships and working with company Aerofoil to help reduce the energy consumption of supermarkets. The device they're building is based on the design of an F1 car's rear wing. It attaches to fridges to keep more cool air in the unit. They estimate it can reduce supermarket energy consumption by 25%. One innovation from F1 is also helping hybrids reduce their carbon footprint. That's KERS, or the Kinetic Energy Recovery System. In common parlance, it's known as regenerative braking and works by storing energy of the car decelerating in a battery for later use. If that's not enough, F1 is now looking at TERS, or a thermal energy recovery system, looking to harness the heat produced from braking and the engine exhaust. That could allow cars to generate the same power using 30% less fuel. So while F1 may have a reputation as a gas guzzler, some of its innovations in the name of speed are helping in the everyday fight against climate change.
Power, policy, politics. From the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect. How did Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg. Markets count down in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles to become Chief Future Officer, like Marriott's Leni Oberg.
One of the most important things is looking around the corner.
Adrian Mitchell from Macy's.
We have to let go of the traditional legacy department store.
And Luca Zaramella at Mondelez.
We tend to believe that all consumers are equal. They are not.
Look for Chief Future Officer on Bloomberg. From the world of politics to the world of business. Balance of Power with David Weston. News, analysis, insight from and about politics power players. Weekdays. This is Bloomberg.
Now, I recognise we have made mistakes. I'm sorry for those mistakes, but I've fixed the mistakes. I've appointed a new Chancellor. We have restored economic stability and fiscal discipline. And what I now want to do is go on and deliver for the public. We were elected on the 2019 manifesto. I'm determined to deliver on that.
You know when you got in trouble as a kid and your parents said you've got to go into school and sit in front of the teacher and this is what you're going to say. This is what you're going to say. And Tom, I'd sit there and I'd go, I know I've made a mistake. I'm here to apologise for my mistakes. Then I'd look back down at my notes. Can I go to class a little bit later? I mean, seriously, the last week or so, Tom, every time I see the Prime Minister right now, it just looks like an individual without any power whatsoever after the events of the last couple of weeks. It's unreal.
What is your vision of how this is solved before we go to Lizzie here?
I don't know, is the answer, Tom.
A lot of people don't know.
Really don't know. Okay. All I do know based on the events of the last couple of days is it looks like the Chancellor's in charge.
We know Sterling 11289 is a litmus paper of this train wreck, and truly, what I learned at IMF, a global train wreck with ramifications worldwide. Lizzie Burden is in London. She is in front of the House of Commons with green leather, the House of Lords with red leather, and joins us this morning. Lizzie, I'm keeping count of the number of, I guess, Tory members saying out, and it was 2. And then I think now it's 4. What's the count this morning or mid-noon your time? And how many ministers have to say out before Truss is out?
I think publicly the herd is 5, which is not massive, and I don't think that there's a particular threshold that they need to hit to change the rules, because this is kind of a different situation. The Tory party is the most successful political party in the world for a reason. Like a snake, it can shed its skin. I think former Chancellor George Osborne said the other day that water will find its way downhill. So if they were to want to replace Liz Truss, they could find a way to do that, although behind the scenes it is said that the letters are going into Sir Graham Brady, the chairman of the 1922 Committee of Tory Backbenchers. But it's not just how they do it, it's also who would they pick. Yesterday in the Commons, it seemed to be an open audition between Truss's cabinet for who would replace Truss. You had Penny Mordaunt, the leader of the Commons, out to bat in place of Truss. She had to reassure the Commons that Truss wasn't actually hiding under her desk. But the problem with Mordaunt is she's thought not to have enough broad government experience to take over. Then you had the Chancellor Jeremy Hunt in his various appearances throughout the day, but he's already lost 2 leadership elections, and he says that he doesn't want to go for another one. There's always Rishi Sunak. He's been notably out of the picture for the past few weeks, but he's seen as a really divisive figure in the party. Perhaps he's staying out of the way because he doesn't want to be seen as a backstabber in the way he was in the downfall of Boris Johnson. But interesting in Westminster, one thing I'm hearing about how Rishi Sunak could square the circle of not having to go to the public to get a mandate via a general election would be to claim that he has more of a link to Boris Johnson's mandate from 2019 because Johnson kind of went out for conduct reasons, not policy reasons, and Sunak would be closer to Johnson than Truss would have been.
Lizzie, I'll allow someone else to explore whether we can see Boris Volume 2. My question for you is focused on policy. The policy announcements of the last 24 hours, how have they been received? And are we ready to see much more of the same before the end of this month?
Yeah, markets do seem to have been pretty calmed by this. It's really hard to understate how much of a reversal it all was. Hunt has managed to close some of the fiscal hole, but he's still got £30 billion plus to go. And in a sense, he's reduced